Okay, today is Wednesday, June 21st, 2017. I'm going to go over a few concepts on the platform structures. This is going to be about candlesticks per the Think or Swam, otherwise known as TOS, TOS, because that's the where you can get the free data. It's the most easily accessible platform due to being free or cheap, and it's also sophisticated enough to surpass a lot of the other junkers out there. In that regard, if you need a free platform and free data, I recommend going to a website called tradingview.com and stockaholics.com, and both of those, I think those are sister sites. The Trading View is a little bit more advanced. They have a live chat forum in there. The Stockaholics may be a little less advanced, but they've also got a forum that's not real time. They do have a real time forum as well, but then they have the main forum where you post, you ask questions, people keep people up to date. It's not a live conversation, it's a regular forum. But their live chat forum is separate, whereas TradingView is right there on the trading platform, and they'll both give you free data, that kind of thing. If you want the advanced features, though, then you've got to pay a monthly subscription. They'll give you a 30-day trial, that kind of thing. But for people that are trying to break into this business, without spending a dime, which I highly recommend, because why spend money if, technology is leverage. And so, people that know that they can make money and beat the competition by giving everybody, a basic entry level use of their applications for free, right? Because it's leverage. They're using the leverage to beat the competition, and so as customers, we take advantage of that, and we use the leverage too, and then we can use that expertise that we develop on these platforms and perhaps purchase from them if we like the platform and we just want to stay with them for whatever reasons, or transfer it over to other platforms and other fields where we do our work. And so, on that tip, I want people to realize that technology is leverage. The concept of leverage is that, if you take a baseball bat and you take an anvil on a tree stump, and you park the car right next to it, and you try to lever that car up with that bat, you're not going to go anywhere. But if I gave you a 200-foot straight as an arrow steel beam, and then we used something that was as big as a washing machine as a fulcrum underneath of it, and then we put that thing underneath the car, we can go out to the end, and a child could actually pull down on that beam and flip the whole car over. Okay, and that's leverage. Leverage is information, so you could spend your whole life, which is going to cost you a lot, figuring out a problem, or you can go to college, take all of the courses on that information, and then do in a few years what it would normally take a whole lifetime to do, because you've got all the inside information on the stuff before you even hit the field. I mean, that's ideal. You know how students are, though. They may be taking classes and then still not know what to do. So, it all depends on how you use it. And in that same regard, where transportation took over foot travel and horse travel, that is also saving you time and also saving you work, because you don't need so much property to store fuel and a few automobiles or tractors or trucks or anything like that. So basically all this leverage does is makes things easier and faster. Okay. And so in finance, we think of leverage as margin and loans and credit. Okay. Bonds are leverage, right? So if a company issues bonds, they are acquiring leverage for themselves. See? And then at the same time, whoever is acquiring those bonds may go to a bank or any other kind of money, somebody who deals in money, and then be accredited so much money to go acquire those bonds, and so they're using leverage as well. And so basically, it's a way of taking control of things and gaining that much more power out of it, but with little, with less and less effort and input. Less and less is required of you. So when we think of technology, right, as leverage, that I have to say that that's going to affect the economy. Okay, the way that the central banks and the fractional reserve lenders in all of the rest of the banks have the entire thing set up. That's money supply, and all of that is based in the principles of capital leverage. Okay, so it's a very significant component to economics, and if you're trading, you should know about that, not only to be able to predict economic moves or industrial moves and that kind of thing, but also to be able to use for your own personal budgets, your own personal business, things like that. And so that you're able to use it and you're able to capitalize yourself and capitalize the people around you. And so that way, when things come crashing down, you're not controlled by the mood that they set on everybody. You have a steel dome around you, and so your mood stays put, and you start doing things about things instead of becoming dependent on them that set the mood on you by crushing your dollar, crushing your industries, your political law systems, etc., etc. Okay, so back to the platforms here. The leverage I'm talking about in gaining access to trading markets, I'd really prefer everybody take the freest route you can. And I think that's basically the only way I've ever been able to get anybody to actually take a look at this practice and start to get into it. Most people say, well, I don't have a lot of money to put into it, so it's like, well, don't worry about that. I can get you capital. You just need to know how to trade it. And then, then the issue of actually investing in platforms and data and that kind of thing. As long as you've got a computer and an internet connection, you can get the platforms for free. There's tons of education. The information about this stuff is all over the internet. You just got to know what is whack information and, gimmick, freebie, bait information. What is fool's information. And there's a lot of both. So, you might be hiking through a lot of underbrush, woods and mountains out there for a while if you don't know nobody that can actually that has already cut through it, has a direct path to it, and then puts you right on the mine, and you can just start paying in pay dirt, right, for free, and then you can actually start, chiseling and picking nuggets off the walls here, right there in front of you on your computers when you get funded. But you've got to learn, you got to learn the basics to the trade before you can get funded. And then you use their leverage, right? So then they put money on you, and they're just diversifying the money. They got a lot of money. They want to invest it. They want to help people. You take advantage of it. They set up the system on the computers and everything so that if you lose too much or, you got a limit, you also have to pass their tests. So that way they aren't losing money, you know. But and so that whole system, that test phase is actually profitable to them. So, you know, it's not like everybody just runs in there and instantly passes. You know, people fail over and over and over, and they can spend each one, you know, thousands of people per company could spend probably hundreds of thousands of dollars a year trying to pass their tests, right? And so that's another reason why you need somebody that can actually that has cut through all the brush and can put you square down on the mine, you know, with a pick in your hand, and you can just start lugging out, you know, your gold ore, okay, and then stamp it out yourself, and, you know, skip everybody else. Just skip all that middleman stuff, skip all the booby traps, skip all the haywire and the underbrush, just get through the mess, get straight to it, and start buying assets, real assets. Not money, not paper, right? Paper, money, shares, bonds, whatever, all that stuff is just paper out there. And technically it's just digits and stuff. You want to transfer that into hard assets, land, real estate, homes, businesses. You want equipment, right? You want precious metals, those kinds of things. You want to get knowledge and skills, okay? And so you also want to like kind of conspire with people, right? So you got to get all your assets in line. You want to get lawyers, right? And so that way, if anything, you know, you start getting attacked, which happens, we see it on the news, they start going after people politically and crazy crap. And the reason why they know they can do that is because you don't have any money. And so if you don't have any money, they can run you out of money, first of all. Then when you run out of money, that's the name of the game. They got you. Boom. You're out of business. You're done. You lose all your assets. And then their people get all the assets. And then that mood, because they set the fear in the air, it persuades people to not go that route, which you should have been able to commit to and complete. And so if you're capitalized, you know, and you got a group of people that are capitalized on the same focus, the same principles, and ready for this kind of thing, they can come and help you too, right? And so if there's a law fight or whatever, then they actually won't go after you. And the reason why is because they know that you can actually prove them wrong. You can afford to prove them wrong. You can afford to bring in news and get coverage. You can tear them to shreds, and that's going to cost them more in the long run, right? Because they actually have monopolistic pursuits, and if you take away some of their monopoly, then that's losing in the immediate term, yeah, because they're going to have to pay all your court costs, and then in the long term, because now they don't have as much market share by avoiding you, and so without as much market share, control of market share gives them more profits, and therefore they lose profits infinitely, right? You have to think of things in a compounded interest kind of way, where more profits means more market share, and more market share means more control of businesses and heads, which means more profit in their favor, which in turn means the same thing over and over, and you get this snowball control effect. But if you're chiseling away at it now, this year, right, down the road, it's a huge chunk of that big snowball, and it just slows them down. So, you know, you want that thing to melt as much as possible. And the only way to get that is to be capitalized with a big ray gun and just start melting them, you know? They want to snow job everybody, you know, on what's right and wrong, true and false. Sure, let's do it. You know, come at them hot and ready. So, back to the access to leverage. The Thinkorswim here is one that I've been recommending. There's I found the TradingView and the Stockaholics. Both are websites. Those are also good leverage, but let's use this for now. I've got I'm going to use the Universal S&P 500 E-mini futures market, and I'm on the 5-minute candlestick chart. So this is about candlesticks. Okay. It's pretty simple. Okay, and I'll keep it simple. And I'll explain these lines here. I actually only use 2 lines, this line and this line. These 2 lines I don't use. And then down here, the MACD histogram, I'll explain that. Okay. First of all, the candlesticks here, you've got the long wick here on the top. You've got the long wick on the bottom. All right, so the longer the wick, it means that there was a retreat there. Okay, it means that basically price got up here so much that basically bears said, I gotta sell and take profits right here because it's not going any higher. And then the other bears said, okay, well, I gotta grab shorts right here because this is going lower. Okay, and so basically both are saying this: there is no future this way headed up. The future is down here. Okay, that's what that says. Okay, so like on a bar like this candlestick, okay, you got a slow movement. There's like a tiny little wick there, there's a tiny little wick there, and it doesn't make any difference, right? It's slow enough. But when you've got this fast wick right here, that's what I call it, is a quick wick. It means that the price got up there and then people got greedy real fast, and that's why the price moved so much. Right? Think of that sound when Speedy Gonzalez runs past, or the Road Runner, right? So that's what that sound is. Okay, and so they're retreating right there. It's the same thing here. The quick tail right there, right? They're retreating right there. It means that down here they're starting to get greedy for long contracts, and the bears are also starting to take profits. You gotta understand that bears made profits all through here, okay? And they want to take profits. It's also getting to that time of day where they want to take off of work, okay? So that you gotta consider the time of day as well. Earlier in the day, everybody's here to work. A couple hours later, they start disappearing. Okay, that's the rule of thumb. And so down here, you got 3 long, quick tails here. Well, that's signaling, things are going this way. And right here, it's kind of obvious to me, even though this one's a little bit delayed today. Okay, this is what is that? 3.5 hours into the day. Usually this cup and handle thing happens earlier, but yeah, here's a little thing that you can see in the candlesticks that I look for. It's a pattern, right? Candlestick pattern, and basically it's this. So it's called a cup and handle, right? So there's the cup, where it comes down here and then it bottoms out and it comes down and then it forms this little handle and then it shoots up. And you can see how fast it was shooting up here. You got straight green, long bars. The fewer bars and the longer they are, the more greed was there. But there's actually more to it than that. What happened was sellers got out of the market, the bears stopped making money, and finally there wasn't that much volume anymore. You can see that the volume starts out okay over here, and then it thins out over here. People are just taking off out of the market, that's all. They got their profits, they're getting out, and so they can't get any more downward pressure. And so this happens every single day, and they tried it once right here, and then it just continued. Obviously the institutions, the hedge funds, and the long-term investors, what they wanted was they wanted to liquidate some of their positions here. Otherwise, this is normal right here. Got that normal bottom out or the normal top out a couple hours into the day. But then if it continues, it tells you that institutions, they have other plans, and so they continue to sell off here. And then finally they quit. The institutions, the long-term investors, they slow down. You can see volumes almost keeled over here. And then what happens is now the bulls can get back in there and take advantage of that. And what they see is that there's a lot of short positions here, And there's also a bunch of limit orders up here. And so when they start to drive these short positions, and you got to remember that these are kind of computers, they're not actually watching the charts. Okay, and also it's other workers that are just putting on a trade and getting out. You know, they've been taking profits, etc., but they always got limit orders here. And so what we need to do is we need to push back against those things and then pop those stops. And then once we hit those stops, you get what is called a bear trap, and that's a short squeeze. And basically what that means is that the bears are buying to cover. So that's one kind of buyer. Then it also means that the bulls are buying to get in and trade, but also to trade against those bears and force them into a trap. So the low volume is easy to overpower because it doesn't take as many contracts. And so when you see that, and you see that that's what's happening, bulls are taking advantage of those bears now, because bears had control here, but now volume's thin, so it's not very hard to overpower the previous regime, right? And so that's what we're doing, is we're overpowering the previous regime. All we need to do is step up the volume. And if we step up the volume, they're actually going to step up the volume for us too, because they have to get out and cover, right? They have to change their position. They either have to go neutral or they have to go bullish themselves and turn around and buy. So they buy to cover, and then they buy long to go with the trend, so they can take advantage of it too. Okay, so basically it's a trifecta of buyers, right? Oh, and then the last one that comes in is everybody that sees this is about to happen and says, yeah, I'm going with that too. Ta-da. All right, so then you get this rocket takeoff. Now sometimes it's short. It can be like this one's a couple of bucks on the S&P 500 E-mini. Sometimes it's longer, it's 8 or 10. But expect about 4 on average, I would say. At least 4. Sometimes, though, once in a while, it'll poke out maybe $1 or 2, and then it'll fail. And that just means that what you did was you got high enough that the long-term investors said, nope, we're not going up today. I'm taking advantage of these higher prices you guys just gave me, you short-term traders, and I'm going to go ahead and sell more to you. Okay, and so then they drive it back down again. Okay, and so that's what happens here. Right? This is normal, right? The market comes down here and bottoms out. You could say this is a little handle, so you got kind of a cup and handle here, right? So this is pretty typical. It's a little bit hidden. It's not as, defined as this handle right here, but it's still there. And then when it gets up here to test, we're looking for actually a bigger short squeeze here, but we only get a couple bucks here, and then it peaks right here at this 34 exponential moving average. That one's mine. And then this is the VWAP line. Okay, and so once it gets up to there and it don't make it past that, what it's saying is that institutions are not buying today, at least not most of them. It's saying that they are more interested in selling. Okay, and so these higher prices is just giving them better prices to sell at, because they can take more profits up here at higher. And so you got this dip here, you got the failure here. On my MACD here, it's getting lower, right? So you're not seeing the MACD getting higher and higher. You're seeing it get lower and lower. You've got this dip here, it bounced back up for one more try. Then you got, what happened was price got up here again, level with the top. Basically, this is like a double top. Right? You should understand what double tops are. And then, a double top is where price met at one price level, then it went back, and then it came back to that price level, and then it fell off again. And that was the signal. Nobody thought that it could go even higher than that. If it breaks through the double top, then it usually rockets up because there's a bunch of stops right there, right? And so once it breaks those stops, it forces traders to exit, and so when they exit, they wind up fueling the squeeze, and it squeezes price higher. And it's kind of like water in your hand, and then you squeeze the water out of your hand. It's kind of like that. And double top is the same as the double bottom. It's just the reverse, the polar reverse. Okay, and I'm going to bring down one of these domes. I'll put it on S&P. Okay, and so here's where it's all taking place at. And so when you understand, where price is at every second on these bars, you got to understand that things are taking place right here, right? So if let's say that a computer program starts slamming the offer over here with sell orders, and so that every time that the buyers increase over here, the computer slams more sell orders, more offers here, and so it dominates the market here, and market can't go up any higher. Well, that's going to trigger people's eyes and other computers to realize that there's a lot of resistance right there, and so they'll start trading the other way. Basically what it signals is that there's a lot of selling pressure, so the money's actually in the other way, and they'll just switch according to that. But the same thing can take place on the other side, 1 tick away or 10 ticks away or whatever, and that's what you got to look for. It's like a sword fight, just because there's resistance at one area don't mean that there's not a counter resistance. You got to constantly look for it and then defend against it. You got to be able to financially defend against it with your strategies. Right, you got to have financial strategies to both cut your, trim your costs, defend against risk, and allow, the market to feed you. Right, the market will just feed you as long as you can stay alive in it. Right, so mainly the main thing is just defending yourself financially from being defeated, and then subsequently you're going to profit, and that's the concept of that's all you got to know. Once you know how to build that lightsaber, that that's it. You've got it from there. You'll never be beaten. But you've got to master it. You've got to practice it. You don't just look at this thing and it comes to you. You have to be in the situation very often, and study it, and then actually practice it. Experiment. Maybe take notes on your experiments and that kind of thing. And so what happened here? Price came up to a certain level, and then there was not as many buyers over here. Okay. First of all, as a matter of fact, there was not as many buyers here in the market. This is the market, right? These are the limit orders. These are the offers. These are the bids. There was not as many buyers in the market, right wherever price was, right? This thing's moving up and down. It's moving up and down on here. Okay, so basically what happened was there were sellers right here, and that's what was happening was their programs and whoever was trying to dump shares in blocks, as well as out there in the stocks that are part of the S&P 500, which are what these futures consist of. And so then futures are getting dumped as well. As a result of that, the computers actually can read what's being sold and what's being bought on the stock market, and they will justify their sales here in the futures market. But not only that, they do have holdings of futures, right? And so it's a little bit complicated, but on both sides, they're just trying to dump whatever on both sides for whatever reason. And there's a myriad of reasons, They could be repositioning. They could be looking long term that we're going to be down lower. They could be getting out of business. They could be fools. They could be right. It doesn't really matter. But the thing is, though, is price came up to here and they were selling right here. They were right here and they were selling all kinds of offers. So every time price comes up to here, they just kept on like shoveling coal into an engine, right? And then it continued and continued and continued. And so eventually, as it continues, we start to read the indicators, we start to read the chart here, the candle bars. We realize that this is going to dip off. Okay, we can't get through this area, and then this little doohickey right here is a quick tail, and so that gives the signal to sell off there. Right. I mean, that was it. Right after that quick tail happened, it was on. So, you know, it's kind of like the, and this is not an opinion. You have to understand the crowd. You know, the crowd understands the crowd. We've been doing this for years. Okay. We know the signals. If we see a comet, okay, at a certain time of day, and it's at a certain trajectory, and it's a certain color, you know, that kind of thing. All right. Everybody in the world saw that. Okay, we don't have to know each other to react to it according to how everybody else is going to react to it, right? It's like if somebody says that the president is a bad man on the news, right? You know, we don't have to know the news person to know that there's going to be a whole bunch of people out there that think the president's a bad person, right? So you know the crowd, you know the crowd's reaction. And so you prepare for it, and it justifies how you take your position. Okay, and that's what happened here. Was this is a signal? This right here, meandering here, not being able to get out of resistance. Now resistance is, you know, that's a resistance line. Okay, bouncing, finally bounced off of it the last time. Left that quick wick. Everybody's going, okay, well, you know. Bounced several times here, couldn't get out, even fell down lower to see if we couldn't pick up buyers down here, and then some momentum. Tried it again, nope, it's not going anywhere. Okay, this is headed down. This is where we realize that the hedge funds, the long-term investors are not interested in buying higher. Not today, probably not this week. It's just something that we can read due to the time of the day that the crowd is doing this. Okay. These are patterns. Okay, I'm talking to you about cup and handles here, resistance and support. Okay, this is a support line right there, right? The support line's on the bottom. The resistance line is on the top. That's just the names that we give them. You know, we're basically, what we're doing is we're finding out where have the computers, the traders that set the computers up, you know, the traders that don't even use computers, where are they setting their marks? Okay, and so we're just figuring out where's the trend, and that's business. That's what you do. You figure out where's the trend. What is the mood? Okay, what's their limitation, and then, you know, you try to be of service, and you go with the mood, with the trend. That's what business is all about. And it's no different in here, but it's more on a micro level. If you're just using charts as your means of business. Okay. I think I'll set this aside for now. I'll give you some more perspective here. I think I'm going to use the oil. Okay, so this is light sweet crude oil. This is Western oil from North America. The other one's Brent. Okay, and it's not a very liquid market. This one is very liquid. You know, futures actually originated, well, hold on, can't be 100% sure, but the biggest futures market is in America. And so that has something to do with why all the futures are American futures on American exchanges. And okay, so now here you've got your oil market today, and so I'll walk you through here. You get a bunch of meandering for a while. Finally, I think probably 7:30, some kind of news broke out. Probably an inventory report, okay, where they talk about how much oil didn't get used and versus how much is on supply. If you've got more oil on supply out of the ground, that means that you've got to burn through more oil. And the law of value is that the more of something there is, and the less that it's demanded, the less that it is worth. Okay, but the less of something that there is, and the more that it's demanded, the more pricing power you can get. You can ask for more and still make some money. Okay, so obviously lately the supply reports have been bad because of the technological leverage out there for drilling, also for finding oil. They've got those HARP things now and similar tools. They can x-ray the world and find all the oil, the copper, the gold, whatever they want, the natural gas. Countries around the world are getting into this. So this stuff gets cheaper. Also, the technology makes it so that you can start pulling it out of the ground in 2 days. That means that you're making money faster rather than 2 years. Right? And so if everybody can do it that cheap, then obviously more people do it, therefore there's more supply. And so you get all these big storage tankers on ground and in the harbors around the world holding all this oil, and people are actually spending less money on oil, on gasoline and that kind of thing too. So, because people are getting stuff delivered all the time. You can go to school online. You don't have to go to the bank. You can just go to the bank online. All these things means less spending on fuel, and technology is so good that they can access more fuel than they ever could underground all around the world. So there's just so much more, and we don't need it as much, and so the price is going to continue to go down here. And you can expect that basically every time that the OPEC cuts production, price will go up a little ways, but as soon as it goes up a little ways, then the American drillers are going to turn on their wells and start to use that higher price and make more money, which means that it tops out, and then OPEC has to cut production again. Therefore, American drillers turn on more wells again. And so basically, this price is going to be driven down lower and lower and lower. You won't see it $100 a barrel ever again. Ever. That's over. But that's not to do with the candles. I'm just trying to get some information out there about these markets and what's ahead. So you know how to use them. Alright, so here's the report that comes out. You get this lightning jolt up here, and to give you some perspective about how much that's worth, one contract from right here to the top up here would make you $400. Okay, so that's a 40-cent jump right there, and not sure how many percent of the whole chart that is, but it's fairly significant. And it can be greater than that. So this was kind of mild, in my opinion. Then it jolts down here as well. So basically, when that information from that report hits, it triggers all of these computers, right? And it's just this mangly web of reactions to the report data and reactions to the reactions to the report data. Okay, and in fact, you can trade this. And I have a strategy that I trade these kinds of things. These are actually the most profitable minutes right here, where it's most volatile. Even though I don't know which way it's going, right? It doesn't matter to me. And again, it comes back to that defensive, always be able to defend, and the rest, they'll just roll it in. Just be able to defend, and they'll just roll it in. As long as you can't get knocked out, then you take home the trophy, the winnings. Okay, so what do we got here? We've got a long tail. I mean, a long wick. Long wick here. Long wick here. Keep in mind that this right here, all of this information right here, applies only to all of this. Okay. Once the economic report hits, all of this stuff before does not apply to this. Okay. All right. Pretty much. I mean, maybe in a vague way, in a distant way, all of this might have something to do with what happens later on in the week or something. But for the most part, this is this is not applicable anymore. What happened after the report is applicable. Okay, and so all that's cut out. Because that's what makes all the difference. And so all those programs and hedgers and everything else, they have to project themselves, into the future, whether they're losing or not, and they have to position themselves immediately, and that's what starts happening. Their programs kick in, reacting to this, and then when they kick in, the rest of us are going to react to what they're doing, which augments everything that they're doing, which those programmers, the big institutions, the long institutions, they are also aware that we're going to do that. And so if they want to get in long at lower prices, they'll kick in a sell-off program. They'll just let that continue on, and then all those sell-off programs are going on. We're getting on top of that ride. We're riding that worm down, and then when we get down to the lower prices, okay, and things start to peter off, like right here started to peter off. Then they're going to go ahead and pick up their bullish positions again at lower prices. So they take advantage of this. So it's like veil over veil over veil over veil of reasons why markets are moving the way that they're moving. And then if you're reading this per candlesticks, keep in mind that the time of the day, the reports out there, okay, around that market, the time of the year matters. All these things matter, okay, and it's just something that you pick up eventually. Eventually you'll pick it up, but for the most part, pay attention to the levels here. So this bar right here doesn't matter, right? This is as significant as the first 3 bars in the morning at the open on the opening bell. They don't matter. Basically what it is, it's just like dump trucks just dumping out shares and picking up shares. It's shorts dumping out shorts, so they're buying to cover, and it's longs dumping out longs, so they're selling, right? And then they're picking up as well. It's just dumping orders out there, big orders. It's coming out fast. There's no rhyme or reason. They're just done with it, and then they're doing whatever they do. They don't sit here and nitpick. They don't necessarily have programs that nitpick for them, okay? And so that's what those 3 bars are about. And they can last a few more bars, but they generally, after the first 15 minutes, they're done. They're done for the day, done for the week, done for the month, who knows? And that's what happens in the morning, every morning at the opening bells. Those first 15 minutes are that. A lot of the pit traders always say that it's the first 30 minutes, but those guys tend to be from the old days when everybody had to sit down in a trading pit, so things were a little bit slower. Now computers make everything a little faster, so I tend to think it's the first 3 bars, and then you start talking business after that, and so they become significant. So 1, 2, 3 bars. All right, now we start talking right here. So what do we got? We got a quick tail right here. That's meaningful to me. It looks like this is kind of resistance right here, but I gotta say that there's some support right here. So we're ranging. I'm not really learning much right here. Okay, this is another little quick wick. And, you know, if I just focus, right, if I just focus right here, these are actually kind of big, right? So, you know, this is 10 cents right here. This is pretty big. 10 cents is pretty big on the CL. Okay. And so this right here, this whole one right here is 10 cents. And this one's about 5 cents. These matter, right? These would matter. These two would matter. They're, what, 40 cents each. But the thing is, though, is that it's too close to that bell right there. Okay? So these matter. Now, what do you got here? You got, right, you got a downward trend, right? Lower high. Remember those words? Lower high. And the opposite way would be higher low. Okay. I got to say here, though, that I've got a higher low right here. So right here, I'm still vague. I don't know what to do. And if I don't know what to do, then I'm not going to take a position in it. Well, I could, actually. I can, because I can defend infinitely as long as I can stay focused and don't burn out. But basically, you've got, what you've got to do here is you've got a support line here, and just draw these things. I want you to draw these things and get used to drawing these things. You're Picasso's now, okay? And so draw up what, you know, how you see on the charts here. And so that way you start to get the language in your mind, and that way every time you look back to the thing, you're always thinking in these lines. And eventually through practice, okay, they'll start to stick in your mind all the time, and then you'll just always see everything in that kind of perspective. Otherwise, if you don't draw these things, what happens is the patterns are kind of like you just don't hear them. You know, they aren't talking to you. You got to make sure that these signs are here so that every time you pass your eyes over that chart, every single time, it says, hey, this means this. And so then in the back of your mind, you're going, okay, well, I'm hearing the crowd. That's what it's all about. You're hearing the crowd. Right? That's all this is a crowd. That's what a market is. Okay, think of the markets as crowds. Okay, and you got to think about what they think about. Okay, which is a little bit of a different subject. I'm going to try to wrap this up real quick. So basically, we didn't break through resistance here, did we? We broke through support here. Okay, and then we get a big leg down. Well, you could put like a stop order right here. If you blow through the stop order on the breakout, then you get in short. You could do the same thing up here, put a stop order here, and then if you break out through there, then you get in long. Or you can just eye this thing. Yeah, it looks like it's headed down, I'm getting short. That was all I needed to know. I mean, all I needed to know was this is a range. It's going to break through. If it breaks through here, this is my median right here. This is the middle of the road, the blue line. Okay, that's the 34 EMA. I call that the money line or the harmony line. Basically, it's always the middle. And I can learn a lot by that. I also can learn a lot by this VWAP here. I can learn a lot by this VWAP here, right? Which I'll tell you about more. I'll tell you more about these lines later on. Okay, but so we break through this level of support, and then we break through the money line and the VWAP line, and now we're down here. Okay, so maybe I trade this, maybe I don't. Doesn't really matter, because this is really talking to me right here, right? So what's all this? This is just, you know, slowly sloughing off. Okay, also my MACD's down here in the red, so what that's telling me is that there are more sellers than buyers. And keep in mind that this MACD and the delta ratio of sellers to buyers, that's a ratio, it's called delta, that pertains to your volume. Okay, that delta ratio is what's inside of these bars. Okay, that's important, because if you've got a high ratio of bulls, okay, and the price has gone up, that's good, right? But if you've got a low ratio of bulls compared to a ratio of bears that's getting higher and higher, but the price continues to go high, okay, that's called divergence. And that means that this bull is not very strong, and it's only going to take like a stick to pop, and it's going to cause a stampede, and they're just all going to sell off. Okay, but if the ratio, the delta, the bullish delta is high, then you can shoot guns and break sticks, whatever. But this thing's going up, okay, because it's so strong, right? But once it becomes piddly, once it becomes, toy business, then it doesn't take much to shear off that crane because it's a toy. Okay, so I'm seeing this, this becomes a no-brainer about right here, right? And so I'd be in short here. I can actually, the way I trade, I can profit on all these little ups and down movements. And then by the time I collect on all those, even if I'm wrong, right, the cost of being wrong is less than what I made on all these little doohickeys, my little strategies. And then on the way down here, right, I'm going to be in for this. Even if I'm in the wrong way, I'm going to get in the right way for this. And then how am I reading this? Well, basically you've got 1, 2, 3 bear bars in a row, okay, which is saying there's too much selling here. That's 15 minutes worth of selling. That's going to tell everybody in the world we're selling here. So nobody's going to buy, and as long as nobody's buying, then this can keep on selling off. One of the ways to do it is this: when this bar ends right here, okay, take profits on what's above you, but get in, right here, and if price pokes up, okay, don't take a big loss. Just maybe a couple of ticks. You can afford a couple of ticks, right? I mean, that's just the cost, right? It's a couple ticks. And put another order right here. Okay, this is your entry. And remember these 4 words: stick to a tick. Okay, so price runs up, and then a lot of times what's going to happen if it keeps on trending, and you think it's going to trend because look at this, right? So it just means that these prices up here are not interesting to anybody because there's no future up here, right? But the prices down here are becoming more and more interesting because there's a future down here. Also, you got to understand that probably because, the oil market, the way it is, people are using less oil these days, and the technology for getting oil is getting better and better. And so, just figure that it's going to be getting cheaper and cheaper. It's easier to go down than to go up. All right, so figure at the close of this bar, that's your entry, right? So get in somewhere around there. Now, if it pokes back up, all right, that'll knock out your stop, or you can back up your stop if you want. I can play defensively and back up my stop all day, and I'll profit either way. But, for basic trader, just if the price is going to come back down, it's going to hit your stop right there. Now you're in short, okay? So let this run. You don't have to profit on all this. You don't need it all. Just, make sure you're profiting and you're making a business, okay? A lot of times what happens is if you stay in too long, the thing goes back on you, and then you lose your profits. Now, then you got mood problems, okay? So, keep yourself happy and just take what you can get. You guarantee yourself something like 5, 6, 8 ticks here. All right. If you want to go the full, what do we got there? 26 ticks, right? That's a pretty big trade. Normally, I won't even stay in for all that unless I've got a lot of backup strategy at the same time, because I'm afraid of what I'm telling you, that I'm gonna get a good trade. I did it right. I don't want this thing to back me out of it, and then I lose it. That happens to everybody. It's like water waves washing into my bucket, and then it just washes out. How would that be? Or fish are in my basket, but then they just swim back out. And They do that over and over again. So I've got to be able to, every time they come in, I got to be able to capture them. And so not being too greedy on these big moves here, you were right. It did sell off. Now grab a big chunk, you know, as fast as it wants to drop, just grab that. Then when it starts to talk about, oh, well, maybe we better start going back up, right, then close the trade and just capture that and then go with the next one. Now here again at the close of this bar, okay, I would enter again. I would risk a few ticks. If it don't, look, see right here on the close, and then it transferred over here and then it just fell off. All right. You know, and the way that you keep an eye on this is you got to watch the clock. You know, when it comes around, here's the clock up here at the top. You know, when it comes around to that 5-minute mark, then that's what you're going to be looking for. And so, same thing here. It closes on the 5-minute mark. Now, I get in here, and it does look like it probably would have stopped me out. Okay, but then I put the stop order there again. Okay, but then it crosses this line at the close of the bar one more time, and then I'm in short. And so I can grab another trade, right? When it gets down here and it starts talking about, well, maybe we don't want to be this far down, well, that's the time I get out. Okay, and then it's the same thing again. Do a little test, knocks me out. I put it back there, and then sure enough, goes right back through this line where it closed on the last bar. Same thing, right down here where it starts to talk about, you know, I don't think this is kind of too low. What do you know? That's when I'm done. All right. And then same thing, you know, after so many bars though, after I've covered so much turf on here, I already know the cat's out of the bag. I'm expecting some traders to start taking profits and just head on out. I'm also expecting some bulls to realize that they're going to start taking profits. Why not start buying? Okay, so you know, you stack those two on top of each other, and the brakes are going to start to come on, and you just got to stand back and see what's going to happen. And that's about, you know, 3, 4, 5 bars in there. That's 15 to 25 minutes. You know, that's a good long time for people to make money, other people to start to see the picture. You know, volume, look at the volume starts to dry up. Whenever volume is drying up, it just means that there's just not as much force over here on the offers, right? So these numbers on the offer, okay, which is where they're selling their limit orders, they start to dwindle down in size, which means that it becomes easier for the buyers to overpower them, right? So you don't have to have like you don't have to have 500 buyers to overpower 499 sellers right here on the offer. You only need like 50 to overpower 49 or whatever. Okay. Another thing I'll show you is this. This looks kind of wild. I use this as well. And it looks a little screwy because the market closed and then it reopened. It just reopened. There we go. Okay, this thing is called the Jigsaw, but basically it's just a heat map. Now, there's two kinds of heat maps. One heat map is where you've got all of the stocks per se. It could be anything. It could be forex currencies, it could be bonds, it could be whatever. But you've got all of the things in on one picture, one graph, and so basically the higher that the stock or whatever has climbed that day compared to the close yesterday, the brighter that the box for it is green. So brighter green means higher percentage that it has climbed since yesterday's close. And then the opposite is true of selling. So the brighter the red, the lower or more percentage it has sold off from yesterday's close. And so if you put all these little boxes that represent all these stocks or different markets and so on one picture, then you get a heat map. Okay? And so you can just glance over them all and see if there's any kind of radical movement, see really what's the mood of the market, kind of all at one glance. Now, that's a different kind of heat map. This kind of heat map is one for this right here. Okay, this is a dome, means depth of market, which is this is the market, right? Here's the crowd. Okay, and the depth is how many orders do they have on the offer and the bid? How deep are they? Right? Depth of market. Right? And so the depth of market is represented right here on this line on any heat map that I'm talking about. I'm not talking about the other one. I'm looking at a dome heat map. There's the jigsaw and then there's the book map that I know of. Okay. The jigsaw is cheaper. The book map is more expensive, but it's much more sophisticated. And if you can use it correctly, you can make more money with it. So, but if you can't, then you would just stick to the cheaper one. All right, and well, that's just business sense, right? You don't invest in something that can't make you money. So you've got the line here, which is at the moment. Okay, like right here. Like so, as let's see, I need to switch this over. Sorry, hold on. All right, so the DOM's on oil, the chart was on oil, the heat map's on oil. This is right now, right? Here's the market at this price right now. This is after market hours, by the way. This is in the evening. Okay, and so it's staying right here at 42.58. Over here, it's at 42.58, right? Okay, and so all of this stuff and all of this stuff, all these orders on the offer and the bid, are represented by these colors right here, right? So the brighter they are, the more bright, the higher that the number of orders are. So for instance, right here, I've got a 97 stack at 42.52. Well, there it is right there. See how it's solid white? You can't get any brighter than that. That just means that it's that more substantially high than the other levels. Now, if you look at the other levels, you've got 711, 795. That's how many orders are there. I got a 47 at 42.50, right? Total white. So it's just that much more contrasting that those orders are at those prices. Okay. Now look what happened though. Okay, that 97 just got out of town. That was at 42.52. So what's going to happen here is that as time moves on, this chart will move this way. Okay, it just naturally moves this way, and you can zoom in. I'm zooming in. Hold on. Let's see here. Huh. It's kind of funny. Well, this thing's all over the place. 3. I don't know what happened here. I'm going to put it back where it was. Alright, and I'll tell you, the Jigsaw Trader will get you done. You just got to figure it out, and it'll work for you. I promise you. I mean, it helps me a lot, And you know, I recommend though, once you really start, you know, running on pay dirt, you know, the road's paid for you, go ahead and spend like a little bit of extra on the book map. It's going to be worth it. It's a lot smoother. Okay, you don't have any like weird bugs and hang-ups and stuff like what we just saw here. Wow, that is really bad. I don't even let's see here. Yeah, see, I'm getting the not responding sign right there. Well, this is gonna work my nerves. Okay. Oh, I see what happened. How'd that happen? Okay, it looks like the slider was slid over. There we go. See how it's got the hourglass on there? Alright, so it's just waiting. Alright, well, if I can get the thing to cooperate, I might be able to show you the rest here. You know, to tell you the truth, I've got a lot of stuff on my computer. Okay, so it is slowing it down a little. So, you know, take that into account, you know, when deciding on what you need, what you want to buy. Alright, let's see, I've got 42, 61 over here. That's up here. So this isn't even right. Okay, well, the basic premise is that you're going to be able to see, you know, contrast in the depth of market in a map. Okay, and so basically what you see right here to the far left was hours ago. Okay, and so you can see the depth of market from hours ago. So if you're just using the dome right here, you can't see anything from hours ago. You can only see what's happening in the present time. Now the old school traders, they used to be able to, you know, look at this depth of market here and then memorize it all day. They could tell you when it got real thick at certain areas. That's things that they remembered. They could tell you if orders started to get pulled at certain areas, and they would just memorize this all day long. And then they got these heat maps. Now, I don't memorize all this stuff, and this would be really annoying to me. But you know, they've all switched over to these heat maps. So the fellas that used to do this pretty much all use this now, and they really don't, you know, the pros that have been doing this for a long time, they don't get the Jigsaw, which is the cheaper one. It's the more, you know, basic one, entry level. They get the book map. Okay, so that's the Major League one. You're also going to get better technicians on it in the background, better customer service. You know, all that stuff comes with. Not to say that the customer service is really negative with this one, but you get what you pay for, you know. All right, so I was saying that down here at 42.52. Wasn't it 52? I believe it was 52. Okay, so you see where the bright white was, and that's where it was 97 contracts on the bid. And then it disappears, right? You can see that it's lighter. I mean, not lighter, but bluer behind, meaning that the number of contracts has decreased, so the depth of market there at 42.50 has become lighter, right? And so basically you can tell the depth of market by the hue on the lines. And then you can do this. Alright, so you can adjust the colors. You can get rid of like insignificant numbers. Like, let's say we don't care about all these low numbers. All we care about is the high numbers, because that's what we're reading about the crowd. We're looking for significant, buyers and sellers out there. Okay, so I can cut out like the basic numbers, and then like the depth scope here. It basically, what it does is it allows you to adjust the. So if you've got a 90, if it takes 90 contracts to make it, block white like this, then what you can do is you can adjust it down so that it only takes 30 contracts to make it block white like this. Or you can increase it so that it takes 1,000 or whatever, but it's all on ratios, so it adjusts itself per market. And then once you're in it, then you can adjust these ratios up here at the top of the screen to get different readouts on it. And then once you understand depth of market, you understand the crowd. Once you understand the crowd, you realize what you're looking for on these things, right? So you can anticipate moves. And another thing that gets into that is the market profile, long-term and daily market profiles. Okay, and then you incorporate all these things: the heat map, the dome, the market profile on the daily. Like a 15-minute chart, or tick chart's good, where it doesn't even take into account any time. Like 5 minutes or 15 minutes or whatever, it just takes into account the prices that it was at. And then when it moves from that price, it shows you that it moves from that price. So it's just a tick chart, not a time chart. And then you put the profile on that, the market profile. The market profile shows you volume per price level on the side of the screen instead of the bottom, right? So we normally use volume at the bottom. And then we normally use these kind of delta indicators to show us what's the ratio of buyers to sellers in there, and then how fast are they changing it up, right? But the profile puts all the volume on the side, so it shows you what's the volume at each of these price levels, each cent, or each tick, or each quarter, if you're on the S&P 500 E-mini, that kind of thing. Okay. And that's something I can get to people about later on. I'll do a video about the profile. I prefer to use the profile on the Investor RT, which is even more sophisticated than the Bookmap. It's more expensive. If you know how to use these things, though, it's well worth your money. Okay, and I mean like quarters to $100 bills. Okay, so it's a really big gain if you know how to use them. And let's see, what else do I need to point out here? Why don't I point out the levels here? So basically we get down to is this going to be a good one? Yeah. No. This was too sharp of a drop right here. I'm going to go to another chart. Oh, I remember now. Before I go to that other chart and show you a little bit more about these candlesticks and then close this down, I'm going to go ahead and show you something else. Let's see here. It's going to be... this dude right here. No. Okay. Well, I might as well talk about these. Yeah. Okay. What you got here are the it's called time and sales. Okay. And so on the left here, you've got time and sales so that it shows, how many of what came out at what time. So you got the time right here to the second. You've got the tick, the price tick, and then you've got the order here. Now I've got this thing set up, it looks like, so that it doesn't show me anything under 20 contracts for the crude oil, which is what this is. And I can take off that filter, and then it'll show me all the way down to the 1 contract. And so this thing moves pretty fast if it's showing everything, from 1 up. But if I filter out the lower numbers, then it moves a little bit slower. And so what I'm looking for is I'm looking for significant numbers, right? At significant ticks. But I'll tell you what, these days I really don't use time and sales very much. Okay, so that's one side of it that shows you everything. This is I forget what they call it. It's basically it's reconstructed time and sales, and basically what it does is does a few things. You got the time here, you got the tick, the price is the tick, and then basically it shows you at that tick how many buyers and how many sellers. It doesn't show you per order over here. It just adds all the orders up at that tick, and then when it moves to the next tick, right, then it does the same thing there. So you can see where it transgressed from 63 to 62 to 61 to 60 to 59, and then it adds up all these, and then what it's supposed to do is say if the sellers were higher than the numbers at that tick, then it will show you a red row to indicate that the sellers beat the buyers on that tick, that price level. Okay, and if the buyers beat the sellers, it should be red. But for some reason, once in a while, it looks like right here, you've got more buyers than sellers right there. But it's red. But then you've got the green over here. These numbers over here on the right are just, okay, since the market opened, or wherever you set it, you can reset this thing, but whenever it begins, it starts to record, it's like a ledger. It takes account of how many sellers or buyers. So let's say right off the bat there's 100 sellers, but then there's, so what it says is there's 100 here. Right, positive 100 contracts on the market, but then 50 sellers come in, okay, and then it says positive 50 because the sellers took away 50 from the buyers, but then it slams it with 500 buyers, so then it says positive 550, but then the sellers slam it back with 450 sellers. So then it says positive 100, but then sellers come in and they slam it with, 2,000 or whatever. Then of course it says that there are 1,900 negative, right? It'll show a little negative right in front of it. Okay. And so it'll keep track of that all day long. And it always starts out at 0, and it shows you how many buyers from 0 are out there, minus all the sellers, or how many sellers there are from 0 minus all the buyers. Okay, and so that kind of I use that sometimes on this right here. It's called a power meter, and let's see if I can get the thing. Yeah, here's one. Okay. So these things come in a couple of different varieties. I don't think this is the oil market right here, but as you can see, there are, almost 800,000 contracts on the sell side, and then almost 800,000 on the buy side. And then what I can tell throughout the day is I can subtract, and I can see, how far ahead or the bears. So if the bears are running the market in the morning, I'm going to have a big sell number. And then when the bulls start closing in and the bears start giving up, the two numbers are going to come back closer to each other. And then I keep track of who's faster, okay? And then I realize that at about the time that they meet, that the market, the move could be over, right? But generally, the thing always equals out. It almost always equals out unless the market trends from high to low and then it closes, or from low to high and then it closes, which happens once in a while, but not very often. But normally the market does a dance and it's up and down and all around. And then by the time you're in the last part of the day, these contracts, sellers and buyers, that's the volume delta, it normally equals out. And I can get into a class about why that is and how that looks on charts and so on and so forth. It relates to something called filling the gap, and there's a whole, bit about all of that, and why a crowd would do that. Why would businesses want to fill the gap? Why would they want to balance out the sellers and the buyers and the volume delta and that kind of thing? And then there's other ones. So there's actually 3 of these on the Jigsaw. And this one they call the power meter, and basically it's just the daily delta ratio, and you can reset it. There we go, reset it. So now it just started over for the whole day. And you can use these, for instance, Peter Davies that made this Jigsaw. This is part of Jigsaw too, these time and sales right here. Okay, this is Jigsaw. This is not, this is Thinkorswim, but these domes, these are Jigsaw, just like the heat map I showed you. But basically, the way Peter Davies made this for himself and people is that when he's into a trade, he can watch this thing. And so when he enters the trade, he resets. And then he keeps track of the sellers versus the buyers and see if there's, if he's going to short this thing, he wants to see that bears are in control. If he sees that bulls are starting to gain on the bears too quickly, then he's out. I use the thing, for instance, if we're having one of those days where we're just selling off all day long, what I look for is I can see that every time that the bulls start to approach those bears increase the sell programs, and they just constantly maintain a 2,000 contract. Now I'm talking about the S&P 500 E-mini. The rest of them I haven't really ever used it on, but on a big sell-off day like that, the bears, they'll constantly maintain a 2,000 contract lead over the bulls, and then it just keeps on pressing down. And about the time that they give up that 2,000 contract lead, it could be 5,000 contracts, it could be 1,000. It'll vary. You got to figure out what's going on in that day, and then you just watch that. And you got to do your math. You got to figure out, what's the ratio here, and see if it's still working. And just keep on following that all the way down. It'll let you know when it's time to get out. When it's time to get out, that's when they pulled that program off, and they don't care anymore. Okay. And so basically when they're liquidating positions, there's a business in it. So they're not only liquidating positions, but you can front run the selling as well. In fact, they can front run their own selling. But generally that's not always effective. You got to let the computers figure out, hey, if the volume's higher, then which way is it going? Well, these things buy so fast that they can transfer billions of dollars in hundreds of trades in under a second, in and out in the same market, right? And so if the computers sense that there's a higher caliber of volume here, and the ratio, the delta ratio to the sell side, then what they'll do is the computer will react instantaneously at nanosecond speed, and scoop up, 100,000, few 100,000. I mean, well, it could be 100,000, yeah. 100 million, a few 100 million from each institution that's doing this, and then sell or liquidate that position in the next nanosecond. They might hold on to pieces if the volume ratio, the delta, is big enough and the ratio's high enough or strong enough. So if it's low volume, they're not going to hold on to it for more than a split second. If the volume's really big, they'll think about holding on to it longer, but then what determines it will be, is the ratio, is the ratio better? I mean, if it's a sell program that they're running, then they want to see a really big bear to bull ratio. But once the bull starts coming back, then it's starting to become less and less of a bearish ratio. So they won't hold on to those front running positions longer. And basically all they're doing is they're sensing the volume, they're faster to grab the contracts, and then they know that everybody else is selling, so all they're going to do is let price go down, and then they're going to, short sellers are looking for contracts. If you just scooped up a bunch of contracts and the price ran down a cent or 5 cents or whatever, but it's $100 million worth, right? You just made some money, it was guaranteed, and then you just hand it off to whoever else wants to short sell, right? So then they may do the same thing, they may go longer, but either way, all you're doing is you're just trying to grab first and then anticipate that you're going to be able to sell it to the demand. And so when it's triggered by that volume and that delta ratio, that's the demand. Okay, so they just front run the demand. Right? And so as the numbers get weaker, they pick up less and they hold on to it for less time. Okay, and that's just how it is in real business. I mean, I always think of textiles, shirts or whatever. What you want to do is you want to grab up as much as possible at first, right? And then you want to get rid of like a lot of it for a good price at first. The longer that you hold on to it, that it's going to be harder to get rid of your inventory. So then you start to slash your prices, right? You might do it one way where you sell for the most at first, or you might sell for the least at first. Try to make a basic profit. Once you get down to a certain amount of your inventory, raise your prices up because there's still good demand on it. And then once you get down to a certain limited amount of your inventory, just break even or whatever, run a sale, right? Just make sure that your inventory is not sticking to you. Otherwise, then, that's where you start to lose money. It's the same thing in here. The exact same concepts are in here. All right. And I was going to go to another market. Basically right here, though, I recall that I looked up and I saw the heat map, right? And, heat map is this dude right here. Right, I looked up and I saw the heat map. Now the heat map is like a second chart. It's not a minute chart. It's not a 5-minute chart. It's a second chart. So if the price ran up and then it ran down, it's going to show me in a line, right? It's a line chart. And I can read candlestick charts and line charts just as easily, but the thing about it is that I can see with the fine-tuned needle precision where the prices were selling it. And I saw that there was a big drop on this thing. Okay, it showed it, and then it showed a double bottom. And then that was right here in this bar right here. And so, if I split this bar up into what's on here, then I can see where the double bottoms are. What's the behavior? I can read the crowd. I know the market mechanics, so I know what they're limited to, and thus what they're gonna do. And so I bought this right here, and it ran up. I mean, it was the obvious buy. So, and it was that time of day. They had a big sell-off. Usually what happens is, if it starts petering out like this, there's not a whole lot of sellers anymore. The volume is down, so, like I said, if you're looking at this delta ratio, and you can see that the bears have given up that domination of 2,000 counts or 1,000 counts or whatever it is in that particular market that day, and they give up that position over the bulls, then the bulls start to gain, then you can bet that they're not going to fight the bulls. They're just going to, the market's going to be taken over by the bulls. Okay. But also, well, first, you got some support right there. It tests support. You got a higher low right there, which means that these prices right here, from the bottom of this wick, quick tail right there, up to the bottom of this wick, which is not a quick tail, those prices right there were not selling. So that means that right there in that time duration, people were looking higher, right? If they were looking lower, then price would dip back lower, back down here. You'd fill in this gap. But they definitely weren't interested in lower prices. Okay? So it's kind of like shorts. If these shorts right here were selling, right, then they'd want to wear them down to here. Okay? But they didn't want to buy any shorts right here. So nobody wanted to wear shorts down to here. Makes sense? They wanted to buy shirts and then wear them on up to here. And I can see at the double bottom, I can see this quick tail. I can see this higher low right here. I can see at the time of day, the ratio here has changed back to bullish right here. Okay, I use this MACD. I know that the price has been away off of this exponential moving average, the 34 EMA, and the price always has to come back to the 34 EMA. That's just how it works. And so, you know, with all those indicators, I'm going to take a long position, but at the same time, remember that I can take any position. It doesn't matter because I can defend myself and I'll always come out profitable. Rarely do I take a loss, and it's just because I'm backed up to my limitations, but it's not so big that it beats everything that I make, not by a long shot. So, but once in a while, you know, I get caught off guard. I really don't have to get caught off guard, but it's my rules and I just stick to them. So, but this is, you know, this isn't a matter of opinion, or this isn't a matter of, you know, my strategy that works backwards and forwards. This is just a matter of all these indicators. It's late in the day. The MACD is turning bullish, right? The delta has become dominated by bulls. You can see that in the green bars here. I want you to remember this and rewind this and then pause this and write this down. See this number right here with the MACD? MACD 513.1. Okay, 513.1. You're going to use that. Normally on a MACD there are two lines. Okay, I just want you to centralize those and simplify this so you aren't reading crossovers, and that'll mess you up. If you're reading the crossovers, it's unnecessary information that's going to affect your mood and then make you position yourself accordingly. You don't need that information, and therefore you don't need those moods. Just unify the line and then make sure that that works. Now, the other thing you got to look at is MACD histogram, and that's what this is. Histogram are these things, okay? So what both of these are doing in unison is they are showing you the volume delta. This is your volume right here, right? The volume delta. Okay. I think I'm gonna have to look at some more charts here, though. Yeah, so put that on there. Put on a 34 exponential moving average. You see it right here, right there at the top in the light blue. Moving average exponential, EMA. Okay, it's got the 34. Okay, that just means that this takes account of 34 bars and then it averages them out. That is the middle of the road. Okay, And I want you to have that on your chart, no matter what your charts are, and then get used to it and study how does the market behave according to it. Basically, the basic rule is that if the market comes up and then turns away from the EMA, whether it's down to it and then up, or up to it and then down, the further away it turns from the line, as in right here it turned, okay, it's that far away. And on this chart it's 20 cents, which is pretty good. That's quite a bit, because this thing will move like $1 or $2 a day. So 20 cents of that on one single turn, right, or the distance from there, is pretty good. It just means that it's turning away at 20 cents away, or percentage. Let's see, the market usually moves on the oil between 1 and 3%, and that is probably about 1/3%. Okay, so just think of these things in percentages, not necessarily, the actual cents, right? The actual prices, because basically what I'm saying is that all these markets are different, right? So the percentage is universal, whereas the actual number of cents is specific to each market. Just remember that. All right. So basically, the thing is, though, is the more distance from this money line that the thing turns, the more powerful that movement is. The closer it gets to the money line and then turns, the weaker that movement is. Okay? So if market comes down and then it comes up, right? Money line's way over here, but then it turned and it was like way far away. Big percentage away, percentage of a daily move. What's the average daily move? Percentage of that percentage, and then it moves down again. It means there's a ton of sellers, because normally what that means is that basically prices are going to run back up here, and then sellers will get interested again. They may continue to move the market down lower and lower, but they would like to see higher prices. And the thing is, though, is that that if it takes higher and higher prices to get that whole market, that whole crowd, to pile in and sell on down, that means that you've got to offer them more and more money, right? Therefore, they're not really that bearish. They're not that bearish if you don't have to offer them anything. So we're still out here way below the money line. We don't even offer them anything. They just want out of this market, okay? So then that means that they're very bearish. They don't even want extra money. They just want out of this whole market altogether. Okay, they are never going to look back. Okay, so that's the kind of bearishness that you can determine by how far away from this money line things turned. Now, a mediocre, playful market, right? Everybody's playing by the rules. There's no big institutions in there trying to reposition, 100 millions and billions of dollars each, or all together, or whatever. It's just, everybody's just doing the thing, patty cakes, take a paycheck and sit back at home. Then what'll happen is, a lot of times you'll get the market price to walk on the e-money line. It'll walk and then it'll turn, right? Which is really interesting. You'll see this all the time. It walks on the e-money line. Now the thing about it is that if it's on the e-money line, or it's right in the e-money line, right? Whenever it's just hanging out there, the thing is very, very prone to go in any direction. There's no message about which way it's going to go. It could go either way. And so therefore it's harder to determine. 50-50 means that it can go either way. The risk is to either side is the same. If you have a 60-40 risk, then you know that the risk is higher to one side and the reward is higher to another side. Therefore, the odds of you being wrong is lower, right? So then if there's a message there, then you can take advantage of that. Not only, well, the main reason is that everybody else sees this. They're not dumb. I mean, they don't use this EMA so much. I don't know why the EMA works, but this is how it turns out. I think that, I mean, the 34 EMA, the money line, I don't know why it works, but this is how it turns out. I think that basically, since the markets are pretty much 75 to about 90% algorithmically driven, but that's to say that the market's really big, and that's not to say that there's not very many people actually doing this manually. Okay, there's a ton of people doing this manually, but the amount of money per day and the amount of transactions per day are dominated by the computers. There's a ton of people doing it. It's still a ton of money for that amount of people. Okay, it's just that the computers can get in and out so fast that the number of trades, thus the amount of money that has come across the line back and forth is substantially higher. They're just faster at it. But basically, they kind of control things. And my theory is that the 34 EMA is rational, and it works because that's where all those kind of computers are kind of mathematical. A lot of people think that the Fibonacci is some kind of secret, perfect number sequence. I don't think so. I don't think everything moves in a Fibonacci kind of number pattern. I think that people just got used to the Fibonacci number, and it kind of works sometimes because it's just self-prophecy. But nobody's ever heard of the 34 EMI. I mean, except for me and maybe another person that I got it from. I doubt there's anybody else. And that old feller, I doubt he got the message out there. So, I think that basically in all of the chaos in all those computers, combined with the people that are doing this manually, I think that there's kind of a harmony wherever the harmony's at. Harmony is kind of like, you have a whole bunch of people singing or whatever, and when you get them all on the same line, even though some are more baritone and some are more high, and then some are trying to manipulate the words a little bit or whatever, there's a kind of medium. That's the harmony. And I think that there's just some kind of mathematical harmony here in all of those algorithms. You got to understand, algorithms are math. It's just a big coliseum of, arithmetic haywire, basically, if you want to think about it like that. Algorithms are what run computers, and computers run off of math. In fact, to tell you the truth, I've studied all this stuff. Language is essentially the same thing, right? So there is a sum of all of these words at the end of each sentence, and then there's a sum in the meaning at the end of each paragraph, okay, where the subject changes, okay, and then overall in the whole book, right? So they are commands, right? Commands that dictate what value is being represented, and then you add up all those values, you get a sum. Computers do the exact same thing, but they do it in algorithms, not in sentences. But it's really the words are interchangeable. Okay. And so an equation is like a sentence, right? An equation is an algorithm. All that kind of thing. It's just that there's so much of it out there doing all these things. I think that there's like a harmony line in it, and this is what works. Now, the VWAP line, on the other hand, this is the purple one. This is the one that all the day trader, like pit traders that are doing futures and that kind of thing, they use that. The big prop shop traders, the ones down there on the pit floor, that kind of thing, they use these VWAP lines. And basically what it is that their clients, they come to them with the hundreds of millions and 500 millions and whatever's, and they want them to put in the orders for them and work the order the best that they can, because what they're afraid of is that if they do it themselves, the clients, If they do it themselves, then what they're going to do is they're going to cause a rally, a bull rally, or a bearish sell-off, and they want, they want the price, the best price. They don't want to be buying way up at the sky. They wanted to buy lower, but if you've got 500 million to go on that day, then you might wind up running the price up there, because as soon as you start knocking down those offers, right, everybody else is going to see how you're knocking down those offers, so they're going to start buying too. And so you're running up the price past the offers, but we're going to run the past price. We're going to run that so fast that you're not going to be able to catch any low prices, and hopefully you'll just keep on buying. I mean, we don't know you, and we don't know what's going on. We just see that the job says, hey, you guys got to invest here because there's a demand right here. So fill in the demand. Do it. Right? And so you're actually telling everybody to do this. So what they do is they give the fellas, down there on the floors or wherever they're working these days, they give them this big order and they want that filled today. And so what they say is that, if you get these things filled above the VWAP, so let's say it's $500 to sell, right? We're going to liquidate or we're going to short, whatever. Okay, so if you get these orders filled above the VWAP, then you get a big bonus. Okay, so that's a big percentage plus towards your pay at the end of the day. So what they want to do is, these guys can manage this. These guys are the wizards of this thing right here. Right, the dome. And so what they're going to do is they're going to work the thing so that the thing does what they want it to do. If they want price to jump down, then they're going to load the offers here. They're going to slam the bids. They're going to pull these things. What they'll first do is they'll load the bids, okay, so that they control the bids, right? So, basically if there's 100 bidders there on a market that averages out about 30 or 40 bids, nobody else is going to put their bids on there, okay? So they'll take control of it. And then what they'll do is they'll just add up over here on the offers. Every time the price runs up, let's say that we're going to draw a line in the sand at 42.70. Every time the price runs up there, all we're going to do is we're going to sell. We're going to run a program, and we're going to tell everybody, hey, if you ever come past this line, 42.70, we're going to run so many sells on you, you're going to wish you were a bear. Okay, so that's what everybody does normally. Now, if there's some really, really, we got to have some bullish positions, we don't care, and then we're going to leave the market, you guys can do whatever you want to do, but we need a bullish position right now, okay, then it's off. Then the game's over. We got to wait for them to get done, or we just take advantage of them. But if not, then basically we're going to draw the sand in the line right now. I mean, the line in the sand right here, and so people say, hey, big sellers right there. This is a short market. We're going to short too, and then we start dragging this on down. Okay. Then at the same time, they can slam these bids out as price goes down. They can pull bids because they were in control of bids. Remember, they set this up so they were in control. They put all their bids there so nobody else would put their bids there. Then as price comes down, they pull the bids right out in front of the price. And that way when they slam with sells, they can slam sells right on top of that little bitty bid that they just made little, because they pulled out all their bids. They were fake bids. Then it doesn't take very much to move that price down. Plus they got help from other sellers that are just there naturally. And they can keep on moving this down. Now, when it gets down here, they can run some kind of sell order if they want. They got people bearish right here. And so bears are going to start to do what? They're going to start to sell. And then down here at these lower prices, which is where they want to get in at long, now they're accumulating. They're accumulating one at a time, very sneakily. They're trying to accumulate. They'll do this over and over and over. Run it down, sneak and accumulate. When they start to catch on out there, they'll hit it real hard and then they'll quit. Then they'll let price run up. They'll take some profits because they gotta stay profitable. They gotta manage their risk. They gotta manage their costs, right? They don't want to start losing money. I mean, they're making money. I mean, if the thing's going up and they're already long, take some profits, put it in your back pocket, save it for a bad trade or something or whatever. But once it gets back up to a level again, then here they go again. They'll draw the line in the sand. They're going to stack their bids over here. These are phony bids. They're going to start to run the sell offers over here. They're going to say, if you ever come across 42.68, right, we're just going to sell to you until you die and give up. Well, everybody else says, hey, you know, they're on the chat forums. They're, you know, texting each other. They're doing this alone. They can see that. Okay, well, we'll just sell right there. Looks like that's what's happening. Big boys are going to control this. We're going to head on down. So they headed on down. Now, at the same time, they pull those bids again. They make little short bids. Then they hit in the market, right? Just market orders, market sells. They don't put any limits on. It's just market sells. Them and everybody else selling dominates these little tiny bids. They move the price down to back to where they want it. Then they start to accumulate again. Okay, and then they get a bigger long position, and then when it runs up again, they take profits again, they draw the line again, they set the whole thing up, okay, until they're done for their client. Now, how that looks on the chart is this. They get a bonus if they, let's say we're doing a bullish position. I was on a bearish position, but then on the dome, I explained it in a bullish way. So it's going to be a bearish position. I'm doing this for a client. This is a bad chart to be doing that on because this is a bearish chart. But let's just say that we've got the VWAP line. So basically what we want to do is we want to shove price on down below the VWAP. Why? Because I get a bonus down there. Okay, so we draw the line in the sand. We set up the phony bids. Then when price gets down to our phony bids, we pull those things fast with computers. Okay, and then we hit with market orders. We push that price down there. Everybody's going, okay, big boys are selling. Let's sell with them. They all get profits. They're all in it. And then they're selling for too long. And then down here, we're actually down here. We're supposed to be buying for this client. And so we're starting to accumulate buys, you know, longs down here at this level down here. You know, and then that's when short sellers realize, hey, they're actually accumulating down here. You know, and it only takes a couple of times before we figure out, hey, there's an iceberg. It's called an iceberg. Why? Because what's under an iceberg? This giant mountain of ice, right? There's only like a small indicator of what's actually below there. And so once we see it happen in a couple of times, we realize, hey, there's somebody filling a big long order. Once we catch on to that, guess what we're going to do? We're going to buy this thing all up. And then we're not even going to listen to the line in the sand. We're going to actually blow right through him because we know he's got stops on the other side there. Once we hit his stops, okay, and then it's all on. Because see, when they draw that line in the sand, they actually have to sell, right? They have to put on shorts, right? So once they put on shorts, it's very risky. They can only give themselves a couple of ticks. If we get wise to what they're doing, we'll just blow through those couple of ticks. We'll hit those stops. Then all those shorts turn into buys, right? When they turn into buys, they invoke the buy programs on all of those computers out there, and they buy too because they're going to front run all that buying, right? So it exacerbates the move. You get the short squeeze. It's called a trap. All right. So, you know, when you think about price and how it moves on the stocks, on the forex, on the futures, and so on and so forth, just remember that this thing is like a little feather in the wind, right? I mean, I think that's the best way to put it. And you can control it. You can move it around only so long, okay? But the thing is, though, is let's just say that we move prices way down because that's where I want. I want real low prices. The thing is, though, is that if I get prices too far down, guess what? Somebody's going to go, holy moly, those are the lowest prices. You know, then they start selling hotcakes down here, and then, you know, it's a heyday. You know, so Now it's nice to get it down there, but somebody's going to say, hey, look, those are the best deals, we're stopping in right here. And then they start buying it back up. So you just never really get away with it too long. You can move it around, you can control it, only so much. Okay. And you got to do it like several times. Okay. Now the thing is, though, is that I'm not going to tell you how. You got to kind of think about it, but normally those VWAP buyers and sellers working for the brokers that are doing that are doing a position for a client, big money client. Okay. You can kind of see where they're taking control in the first part of the day. The rest of the day is kind of off. Everybody's already out by then. It's kind of over by then. Okay. But think about that. Eventually it'll come to you. It's one of those things that all of the traders that have been doing this for 30 years and so forth, they all know about, because they were actually on the floor doing it. They were either doing it for their broker, or they were the broker. Okay, what else? I was going to show you. Oh, the advanced dome. Yeah. Okay, this thing just reset for the evening, but normally the thing is, it's full of numbers, all up and down. Okay, now this is an advanced dome, right? It's like this. This is a regular dome. This is, you know what? I actually said earlier that this was a Jigsaw trading dome. This is a NinjaTrader dome. Okay. Everything else that I said was Jigsaw is Jigsaw, except that this thing is NinjaTrader. And basically, this is your bare bottom, futures trader platform. Right? The bare bottom, the cheapest, basic entry platform. You're going to save the money. Okay. Start small. That's how you do business. Okay. That way you're profitable. I mean, unless you're just doing something that's so, like you got it. Like, I mean, let's say that you were like selling, I don't know, something hot. Like, let's say that you invented iPods. Okay. Well, don't invest cheap, and start out cheap. Get the best stuff right away. Right, because you're going to sell a ton of these things, so it's going to surpass everything you invested. You don't want to break down. You got to sell these things as fast as possible, so you got to make them as fast as possible. So you got to have the best equipment that you can possibly get, because the profits are so big. You don't want any other competitors getting in on your market, right? So there's where you need to start out with the best equipment that there is. Then if it's something like, let's say you're starting out as an arborist or a construction dude for, building houses or adding on add-ons, okay, then, you kind of want to go to like Craigslist and eBay and things like that and get used stuff. You want to go to the auctions and that kind of thing and start out low, get some stuff with some use on it, but it's still going to work. By the time you break like 9 of the things, you could have bought a new one. That's the best kind of investment. And then if you really need the new stuff, because you've got so much business that you can't be buying used stuff all the time, hunting down deals. You can't be, fixing stuff all the time. You got to have things last as long as possible. Not only that, you want your workers using good stuff so they feel elite, so they're working better maybe. You also want your customers to look at your stuff and say, you know what, this is the best outfit. They're going to tell other people about, wow, this is a really good outfit. You want them on your property because they just look so good. They work good too. So it actually sells itself. But when you're at the beginning stage, get that entry level stuff, because you know what, tree care and people working on houses and stuff, that ain't the newest and latest greatest thing. This is pretty old business. going back probably thousands of years. So you got to start out small and stay profitable the whole way. Whereas if it's hot, you got to sell as much of it as possible. You got to have as few breakdowns as possible. So you got to invest in the best stuff, you know. And then once your business is hot, let's say you've got a hot tree care service or a hot construction service, you've always got demand. They're always deep pocket. They're always paying good profit margins. You got to keep up. You're going to try to capitalize on as many of those in 1 year as possible. Well, you got to have the best equipment. I mean, you're loading up the best guns, so to speak, possible, because you don't want anything going down that whole year, so that at the end of the year, you got nothing stopped you. You capitalized the most on that year. You looked the best that year to the most number of people. Nothing slowed you down. So you made the most. And then that perfect year invests in the next year. That kind of thing. With this, if you are new to trading, then you want to start out with the very bare bottom stuff. Free, absolutely free, if you can. And that's what I always point people to, is the free stuff, because there's no use spending anything if you don't have to. You don't have to have the best stuff, because you wouldn't even make money on the best stuff. You know, it wouldn't be profitable for you. Just start out with the free stuff and then learn from there. Once you learn the language of the business, then you can actually make money on the more sophisticated stuff that actually costs you money to access. Now, if you were a trader and you were good for like 10 years or something like that, and then you took 10 years off because you went out scuba diving with the whales and the dolphins and the sharks and stuff, and then 10 years later you come back, you got to do this again because you spent all your money. Okay, so then it would pay for you to actually invest in the best stuff, right? You wouldn't want to start out the bare bottom, because you're not learning this. You already know the language. You already have hands-on experience to masterpiece. You get the best stuff and you're going to be that much more profitable, right? So there's the difference. And that's basic business, basic business mechanics. That's proper business strategy, okay? So I'm a little off subject here, but this is the Jigsaw Advanced Dome. And basically, we're on the oil market here again. Prices right here, it shows, okay? In fact, we're bouncing back and forth before this offer and this bid, okay? It'll light up where it's bouncing back and forth. It always bounces back and forth between an offer and a bid. Okay, this is the market orders. This is where the market orders come out. The limit orders meet each other. All the orders are executed right down the middle, just like down the middle here. Okay, so, but the thing is you can actually see what's going on here. See, this gives you more of that delta volume ratio perspective. So it allows you to look inside of this price right here. It allows you to see what happened in the past without having to memorize it all, which is very difficult. It allows you over here on the right to look inside of each of these bars and these volume bars and actually see the MACD firsthand. And so I'll tell you, it gives you a couple of different things here. So basically what you've got here is you got 190 sellers hit the bids over here. Okay, you got 60 buyers hit the offers over here. Offers are sellers, bids are buyers, right? They got these limit orders here. They want to buy. Sellers sell to them. Trade complete. You've got these offers over here. They want to sell at certain prices, not other prices. Buyers, they buy from them. Okay, order complete. Now you can see, I think this is called snapshot right in here. And basically what it is Let's see if I can pull it up. Now you guys got to learn, you got to like rewind this. If you don't understand it, you got to rewind it. Okay? A lot of people just zoom through these things and then they don't rewind and they don't learn anything, because you got to actually, some of these things are so complex on the internet. You got to reread it. You got to relook at things. You got to like, what were all those words this woman just said? I'm going to get the full thing so I know exactly what this phenomenon is about. And then once you have built that, you've rewinded it, you built it in your mind, now you can see what's in that industry, what's in that field of research. Okay? If you don't rewind, then you're blind. So to speak. I mean, this is metaphor, ancient metaphor. Okay. So over here we've got this overall daily power meter. This is snapshot. Okay. Now this doesn't pertain to this particular market right here. This pertains to another market, but it'll work for this. And so basically what we're seeing is we've got two sides here. We've got the this thing will bounce back and forth between this price and this price. Okay. The bids get approached by the sellers here on the 61, okay, and then the offers get approached by the buyers here on the 62, okay, and then once we move up, if the buyers take control here and we move it up to the 63, then the bids on the 62 get approached. Looks like the sellers took over here. We might get this thing to move down. So that's what's moving price. And so basically you've got yeah, we moved it down. Now the buyers here on the bid at 60 get approached by the sellers, okay? And so now the offers at 61 here get approached by the buyers until one of them overpowers, the bids or the offers. Now the thing is though, is you've got two ticks here, okay? So that's what's going on right here. This is for probably the S&P E-mini or the 6E Euro futures market. I don't know, but it could be the bonds or whatever. But the thing is though, is that you've got the lower tick, okay, with the red out here on the market, okay, not the limit orders. These are the limit orders, okay. And then you've got the higher tick in the blue here, out here on the market, not the limit orders, okay? And so that's what this is keeping track of, okay? So you can compare the ratio per price movement. You can compare the ratio. That's how you read that, okay? This may be the CL, but that just moved right at the same time, right? So anyway, there's 3 of these meters. Okay, and you can look into that and get that defined for yourself. If there's any question about that, just email Peter Davies. He answers questions. It's not like a big industry. It's not like he's got millions of customers or anything. I've contacted Mr. Davies many times. He does lots of interviews and coaching sessions. He's also got lots of videos that explain his stuff. Now these out here are how many orders have disappeared, okay, so, or been added, right? So basically you got sellers here 20 or whatever. It may be more than what there actually was there. That 20 may be actually higher than what it was. But the thing is, okay, yeah, right here. Yeah, okay. So 0, right? Starts at 0. Now look at 29 and the 1. Keep an eye on that. 1 out here, 29. What happened? So it added 2 and it went to 30, but then somebody sold 1. Somebody sold 1. Okay. So it went back to 29. Okay, you understand that? So basically, if this right here, the bids right here are going lower, watch it, 41 bid, okay? Then it sold 3, but it added 1, so you got 39. Just do the math, right? 41, sold 3, that would give you 38, but then it added 3, so then, or whatever. Actually, I forgot it. Okay, but I think that if you're smart enough, okay, which we are, now watch it here. Okay, now see how the number went up, the bid went up because this number went up, and it'll go up exactly the same. Then it sold 1, okay, but then it went up 1 over here, so it went up to 43, right? Okay, now it's up to 44, but it sold 2 and it added 5, right? And then you see this one right here. So if this 7 drops down to 0 and then it goes even lower, then it starts into a negative number, right? And so what this tells you is, if, remember how I told you they can pull orders, and they'll take control, they'll put all their phony orders in here, and then as soon as price gets down there, they'll pull the orders so that the bids or the offers or whatever are small, and then it's easy to push price past them so they can get price to move. Okay. Now there are programs that counter that, but there are a lot of traders that just want to know, hey, which way is this thing going? I mean, if you're going lower and I want to buy, I want you to move it lower. I don't care. And if if you're a buyer, and you don't want the price to move lower, geez, you'll kick in a big program and you'll say, hey, look, every time they pull orders, add orders. I don't care. And then whoever's pulling orders is going to give up on you and wait. You know why? Because they got stops over here somewhere, right? So you can actually start to push this up and then hit their stops. Now that's all going on in there all the time, and it all equals out. This has been going on for years. It doesn't have anything to do with the rest of the economy. This is an industry just like all those stores in the mall, on the strip, all the clubs, all of the manufacturers, all of the retail stores, right? They're all doing basically the same thing, but here it's just in a really small microcosm, okay? And, it's not like if you're working at Walmart and then, price is moving around on the markets. You don't feel that. The only time you feel something is when the stupid central banks pull out all the money supply out of the economy. Then money becomes so rare, then you start to feel it, right? Otherwise, everything else, as long as there's plenty of money supply out there, right? The government should issue money supply, not the central banks, by the way. Because the central banks, you've actually got to pay them for money that you could print yourself. And then in order to pay the debt, so they issue money supply. And then in order to pay the interest on that money supply, you got to borrow more money. And if you pay off all the debt, you don't have any money. Right? But that's actually something that we're just learning about in this era. This was rare knowledge previous to the internet. But basically, the thing is that basic economic rules. If you're selling stuff, it's because people want to buy your stuff. Okay? And if you're able to hire somebody, it's because the amount of money that you can make when you sell your employees' products is higher than what it costs to pay your employees. But if your employees cost more than what you can make out on the market by selling their stuff, you have no business, right? So then that's why manufacturing companies go to other countries, and it's also why people come to this country to work under the table. So, if you're a business and you've got to pay taxes, you got to pay employee taxes, you got to pay employee insurance, you got to pay workplace or work site insurances, you got to pay insurances on all the equipment, the trucks, you got to get licenses, you got to train, you got equipment that's blowing out all the time, you got to have insurance on the customer's property, the customers that buy your stuff, malpractice insurance. You got to have all these things set up. You got to have lawyers sometimes, blah, blah, blah. and if somebody else can just walk in and say, hey, look, we'll just do it for cash under the table, we don't pay for any of that stuff, and it's on you. If we mess up, we're not even from here, we don't care. Well, hell, everybody's gonna do that, right? And I mean, if the cost of making something is higher than the actual price you can get when you sell it to the market out there, then you're either going to have people coming in to do it for nothing, or you're going to have to send your business overseas, and then they're going to do it for nothing, and overseas they're going to actually make sure that it's done for nothing because they're getting rich. The international corporations are getting rich, and everybody else in between. They're making money. That's how they make money, and that's how they make them rich over there, right? And if you're over here and you're getting wealthy on the people that are coming in, you're going to argue for their rights. You're not going to argue for your country's rights. You're going to argue for them, right? Because that's where you're making your money, because you've got everything backwards. You've got the cost to make something higher than the actual price you can get. Okay. And there's a reason for that. It's actually called Fabian warfare. It's where you take control of all the economics and the laws and the social narrative of a country and weaken them, and then you conquer them when they're weak, not when they're strong. And capitalism is very strong. Christian people are, ordinarily capitalists, and that combination and nationalism on top of that is a very strong country. So if you want to take over that country, you have to weaken them first, and that's what we're going through right now. And there are people that are benefiting, like those people in those other countries, I guess, yeah. And people that are, snooping around here from other countries. But anyway, the thing is, though, is that where did I get off here? I did get off there. Okay, so this outer number right here, that is how many orders are being added and how many orders are being pulled. So if you see that there's a whole bunch of numbers right here going up and up and up, right, on the buy right here in the market, and you see that this number is just staying the same, but this number is climbing, right? It just means that as they are buying from this offer stack right here, there are programs that are adding more and more and more. It's like they're shoveling coal into there. Okay? It just means that there's a lot of there's a deep market right here. It's going to be hard to get past it. Okay, so that's what you would take from that. But over here, if you see that there was a large number and then there's a big negative number, right? This is small, right? It wasn't because the bid didn't get small because there was a whole bunch of sellers. The bid got small because there was a whole bunch of pullers. Okay. Now, if they're pulling a lot, okay, then that means that there's somebody trying to push down price. And if you see that they're adding orders over here to the offer, it can mean that price can go this way. But you've got to remember that they can do the exact opposite the other way. And what I've noticed in the S&P 500 E-mini, which probably is not uncommon in every other market or stock or whatever, is that they'll draw a line up here and they'll draw a line down here, and that's when you get your ranges. You get those tight little uniform ranges, and then sometimes they start to bunch up. So at first they'll draw the line up here, and then it'll bounce down here, and they'll draw the line down here. Okay, for whatever reason. They might be accumulating, or they're just trying to get price to come back up here. Right, because they can force price up too. I mean, the line in the sand thing, works both ways. But then basically, if they can't get all the way back down there, and it starts to climb up, right? So now the line in the sand is like up several ticks from where it were, and then that basically buyers are stronger than sellers here, and so breakout's going to probably pop up over the line in the sand. Now, that's kind of what they want. And then how that would look is it looks like what they call a flag pennant or a flag or a wedge. Now, I don't get too deep into the wedges, the pennants, and the ordinary square flag. But as you can see here, we've got this trend down, and so if this were on this, then basically what it's saying is it wants price to go down. Okay, because why? Because it's not buying anything to go higher. It's selling lower, right? And so basically you got a range. Let's say the range is down, right down here. Starts out right here, then it moves down here. So okay, so the thing moved. Hold on. The last one. Yeah, I don't use this thing much anymore. I studied this thing for a long time until I just kind of understood the physics of it. And then once I understood the mechanical physics of it, then I could speak the language. And so once I could speak the language, all I got to do is read it. I don't have to speak it. I just got to read it. And so now I can read these charts, these candlesticks out here. But anyway, so basically the range starts out, like let's say right up, here and here. But then it moved on down. Slowly but surely the line lowered down, but the bottom of the range stayed the same somewhere, okay, on here, right? Let's say 42.57, okay, but then it drops down lower, right, and then it makes a new line. So now the new line's like at look, 42.49, and so, but the thing is, though, is that line in the sand above gets lower and lower and lower. Okay. And then finally, it breaks through. So the reason why it breaks through is we can see what they're going to do. Once it's clear what we're going to do, we're just going to get in alongside of them. Not only are we going to get in alongside of them, if we're holding a long position and they're lowering this thing systematically like that, you don't want to be holding along in that situation. So as soon as you pull out all your long positions, guess what? You just sold a bunch. And if you're selling a bunch when everybody else is shorting, well, then the market's going to fall off. And then once you get it low enough past the stops, right, where the bull stops are, they don't want to go any lower than this. They put all their stops in the area. And then that cascades, and once that cascades, you see all this volume right here. Once that volume kicks in, then all the sell programs, they hear you. It's like buzzards from hundreds of miles away smell something. And so, like flies to bull biscuits, they run to it. And then they exacerbate the movement. Okay, and so that's why you were short. That's what you were looking for. You were looking for that trap to break. That's called a breakout. And you can see these things on the charts, right? It's where they break through support. It's where they break through resistance. All right, and then the rest of this. So these are pulling orders. These are pulling orders. These are. This is volume profile, essentially. They may have a different name for it, but basically this blue and this red combined equals this. So 421 plus 420 plus 241 adds up to 661. How do I know? I just know. I don't even have to think about it, but do it in your head there, and you get the same thing. But automatically, you know that because that's what this number means. It means these two numbers added up on each of these ticks, each of these price levels. And that's all that means. You can reset all this stuff. You can just sweep all this stuff out. I've got mine set for resetting at the beginning of the market every day. Where does it? Yeah, right here it says reset on new session. So at the beginning of the session, all this stuff resets. But then it collects data all day long, and I can see where it's been. And basically what I'm trying to see is where did it trade the most? You know, because that's the levels that I'm looking at. And basically what that is they've got computer programs in there that switch and do other things. So like if I'm a hedge fund and I say, okay, I'm interested in such and such stock. Well, if price comes down to that price right there, basically I'm just going to grab that, and then eventually it just becomes a big node that sticks out on the side, okay, and it just says that if price goes down to there, probably they're going to buy up a bunch. Now, if they're buying up bunches down there, what's probably going to happen is the bulls are going to run up, right? They're going to run away. So if it comes close to that, then bulls are going to start to look the other way, right? Bears are going to probably disappear too, because it's probably not going to go past that profile, market profile or volume profile node, right? And so they've actually got big charts. They've actually got big market profile nodes that stick out. Shows the volume per the price. And so here it's just more intricate. It's per day, or you can reset this and you can have it per trade, per hour. Just reset this every hour. You can reset the total volume here. Mine I just reset, every day at the beginning, and then everything before is just whatever. The book map keeps track of the day, keeps track of yesterday's, keeps track of the last 5 days all in one, and then keeps track of like the last month or total combined, that kind of thing, so you can actually get more intricate, and that's where it becomes more valuable to you. And so that's just about reading the crowd. Now you got to understand that if you can read the crowd can read the crowd too. So you want to know what the crowd's reading. And therefore you understand more about why they were doing something or why they didn't do something. Right. And so you just become more of a trend savvy business person. That's your job. That's what you do. You got to study what is the mood of the crowd out there, and therefore you service the mood. What are they wanting? Service them. What don't they want? Well, stay away from it unless you've got a really good edge and you can afford it. Like for instance, Saudi Arabia can get oil out of the ground at $10 a barrel. Nobody else in the world can do that. So where everybody else says, no way, I'm switching off the pumps, the wells, I'm switching off the wells because I can't make any money any lower than this price. Saudi Arabia can stay on. They can keep theirs on because they can actually make money lower. Right? So, you understand, you got to understand all these things to understand why the crowd is doing what they're doing. Why are prices only worth what they're worth? Remember that a price is a belief. It's a faith. Okay, it's if I say that my my Ninja G.I. Joe man, little 5-inch figure, is worth $10,000. To me, I believe it's worth $10,000, or maybe I don't, but that's just what I'm gonna see. If I say it to you, then you say, "Wow, that means a lot to you." So then maybe you're gonna raise your price in order to get this little collector dude. Okay. So then from $5, maybe you offer me 10.
So, you know, there's that too. Now, if I think that this thing is worth nothing and I'm just going to pay you a couple of dollars, so you take it, okay, then, you know, obviously it's worth something to you. And you might be able to turn it around and sell it yourself, right? So, you know, it's just all about belief. And I'll give you a little bit of business wisdom. There's three kinds of people out there that you can do business with. There's people, most people don't understand business, and they don't want to, they don't care, okay? And so, you know, when they work, they do good things for people, and then basically what they do is learn how to do good things for people, okay? And so that's how they make money. And so when you're buying things from them, like let's say you're buying used things for them, then basically what you can say is, you know what, I'm going to offer you this much money. It's lower than what you want. What do you say? Most people will, you know, go ahead and get rid of it for that much. So you can save money like that. Most people are like that. Another kind of person, which is fewer, is the person that's in an emergency. So they got to sell this thing, okay? And so because they got problems or whatever, their balance is off. They are in the red. Things are going bad. They got to get out of it. You know, they don't know anybody that'll give them a good deal, so they have to do a deal with a stranger. And so somebody like me goes, okay, this guy's in an emergency. I don't know what's going on over here, but sure, yeah, I'll take it off your hands for this amount of money. Okay, deal. Just, yeah, all right, see you later. Well, see, I got a deal there. He had to get out of that thing. He didn't have any better offers. You know, time was of the essence, right? You can get deals like that all the time. I see them on Craigslist all the time. People are saying, oh, I got to move. I got to, you know, deploy, that kind of thing. I just need to get out of this and put this stuff in money. I can't be watching these cars or gaming computers or whatever. You know, so they get out of it. Now, to me as a person, I can say, okay, they can get rid of this stuff for cheap. Well, then I can turn around and sell it for a little bit more, right? If I've got the storage and, you know, I want to deal with the selling and everything. Okay, so that's two kinds of people. And if you watch the Pawn Stars, them kind of guys, that's what they're fishing for. That's why they ask you questions. That's why they make you offers and they hold their cards tight with poker faces. Because what they're trying to do is they're trying to see if you got an emergency. And then second of all, they want to see if you'll actually go down lower on the price. And then lastly, you know, they got to be able to get that thing sold as fast as possible. So the quicker they can sell it for profit, the better. Therefore, the lower they can get that price, the safer it is for them. Because if they're just buying stuff too high and it's sitting on the shelf, they can't sell it for profit. They're putting risk on their company. And that's just not how you do business. Then you're not doing anybody a favor because you went out of business. Now, the third kind of person is them. Those kind of people. Myself, right? We understand these two kinds of people. So when you come across another person that is business savvy, that understands these fundamentals of being a broker, brokering deals, you know, buyers and sellers, for other people, right, who are always trying to get the lowest price, okay, and so they're there with an emergency fund. If you gotta get out of something, you gotta get the money out of something, you gotta transfer the value into something else. That's what your emergency is about. Or it's just taking up space and you're just gonna let it go to somebody else that can use it. You know, you can get a little bit of something out of it, but you really don't care. You're just doing everybody a favor, and all's well. You're taken care of. But then you run into somebody like me, okay, or the Pawn Stars or whatever, right? You're just not going to be able to get that kind of deal. You got to be a broker to get a deal, which means that you've got more business coming. So if you get a good deal out of another broker, another business broker, maybe it's somebody that buys stuff from overseas and then sells it here to different retail stores. So they buy a big bulk load, okay, and then they hit all their the retail store buddies, and you know, They got all these connections. Well, the thing is, though, is the only reason why you get a better deal out of them is because they know that they got more business with you in the future. That's it. So more guaranteed business, therefore you're worth more, therefore they can knock the price down. That's why when you buy in bulk, you get a better deal. You understand? That's why when you're a steady buyer, you've been buying for a long time, then they can knock down the deal because they know that you're always in business, you're always staying in business, so that they want to make sure that they have that kind of market share in their portfolio, on their Rolodex. Okay. And that actually plays out on the markets here. For instance, right here at this level, we've got a bunch of stops right here. Well, guess what? They're in an emergency. They're long. There's longs right here at this position. Okay? And when bears pushed them out, guess what? They're in an emergency. They got to sell. So who's there who's there to buy them? Actually, we're down here. Right? After we take a profit. Okay? So there's that. But we're there. So you don't even have to go all the way down. In fact, we might be able to just take your business right here. Right? Then you don't have to go all the way down to zero. Isn't that better? Right? You're just going to lose a little bit. Okay? And then you become a better businessman or businesswoman. And you do the job right. Okay, I think that's it. I think I'll just I wanted to fit in options here. All right, let's take a look here. Let's go with the tried and true, ever faithful S&P 500 E-mini futures. So these are futures options. You got the SPY options, which are an ETF. ETFs, they are equity traded funds, I believe that's what they stand for. They can be anything, but basically they trade like stocks. So when you're buying and selling ETFs, those are shares. The equity futures, like the S&P 500, the Russell 2000, the Dow, the NASDAQ, okay, those futures consist of blocks of shares in the stocks in those indexes. Okay, now the SPY actually deals with the futures. All right, so the SPY is actually based on the futures. When you buy and sell the SPY, you're actually, the algorithms are there controlling the buying and the selling of the futures. And the buying and the selling of the futures are actually controlling the buying and the selling of the actual stocks in those indexes. The SPY is an S&P 500 E-mini ETF. Now there are multiple ETFs. It's just that the SPY is the biggest one. Just like the S&P 500 E-mini futures market is the biggest market, other than Forex. Oh, and the bonds. But as far as being the most traded, the S&P 500 has been the vanguard in this business. It's just that's the spot. That's the club. That's the bar that everybody goes to. It's the rendezvous. It's where you start. It's probably where you end. You train on this thing. This is where it all starts. This is where the liquidity is guaranteed. Everybody knows the most about it. There's the most news on it. Like, there's not as much news on anything else in the entire Wall Street industry around the world, whether it's Shanghai, Hang Seng, London, Berlin, Singapore, Sydney, Australia, down there in Brazil, However, it doesn't matter. The most reported on market in the world is the S&P 500. Why? Because it's in the number one capital country, right? The laws here protect capitalism more than anywhere else. Okay? There's a lot of reason for that. And also, the buyers are here. This is where all the businesses are, because this is where all the buyers are. Not all the businesses. This is where the main businesses are, right? I mean, we don't sell tons and tons of stuff to Mexico and China, right? They sell tons and tons of stuff to us, right? You understand? And that's why the businesses here are the biggest. And they are in the top 500 businesses in America are in the S&P 500, okay? And therefore, it's the most liquid market in the world, the most liquid equity market, okay? And so these futures are thus that they're liquid for that very reason, okay? That's why everybody's about it. It's all, all the news is on it. Everybody heard of it. Everybody understands it. It's the bellwether of not just American economics. It's the bellwether of world economics. It's what politicians in China look to. It's what politicians in Congress here in the United States look to. In every state Congress, the mayors, and everybody is kind of like looking at that thing. Okay. It's what the central banks look at, right? The slimy central banksters. All right. So that's the ETF, the SPY ETF. Now that SPY ETF is done by Spider. They got a lot of ETFs. There's other ETF funds that make their own ETFs on these markets. Their Spider ETFs are very, it's SPDR. It's an acronym, but we just say Spider. Their Spider ETFs are very, very common. There are other funds that make very popular ETFs. Vanguard makes the VXX, which is the most popular VIX ETF. I know that the most popular oil ETF is not done by either one of them. I'm not sure who the NASDAQ QQQ ETF is done by. The thing is, though, is that they are based on the futures. All right, but then, you've got stock ETFs too and whatever. I mean, you can have Forex ETFs. You can have any kind of ETF you want. For instance, there are ETFs about tech stocks, biopharmaceutical stocks, bank stocks, industrial stocks, internet stocks, on and on and on. And they make a ton of ETFs. Some of them work, some of them don't. And then if they don't work, they just take it off. It wasn't very popular. There are funds that can actually make an ETF that you want. So if they get enough requests from people, then they will make an ETF for you. Excuse me. Okay, so the options here. Why don't we go to all? All right, so this number right here represents how many days are left are in these options. These options don't last forever. They expire. Now, why do we use options? It's because we want leverage, right? So, hold on. We want leverage, right? I taught you about leverage. Leverage just gives you more power on the same thing. So, let's say I want 1,000 Facebook shares, and the stock is at $100 even. So at $100 Steven, that's gonna make me have to invest $100,000. But if I can get the options for 5 cents a share, then let's see if this calculator works on here. I don't know what was going on, and it works. Okay, so I got 100,000. Let's see, 100,000. Let's see. I want 1,000 shares, right? 1,000 shares times 0.05 cents a share. That's $50. Okay, but if I want 1,000 shares at 100 a piece, $100 a piece, it's $100,000. So what do you want, 50 or 100,000? Well, it depends, right? It depends on how much time you've got to sit there and take care of your options, right? Because these options, right, they expire. The value dwindles down as time goes by. You understand? So if now take a look here, prices go down and become higher. This is the S&P 500. Okay. So basically we've got 2340 here at the top. We've got 25, 35 down here at the bottom, right? That's $95 difference. Okay. Lower at the top, higher at the bottom. That's just how options are. If you want to become an options trader, I recommend it, and you got to learn that. Options are kind of like a 3D chess game compared to ordinary futures and stocks. Okay, if you're into the 3D chess thing, you're probably into macroeconomics in all of the industries, all of the investment vehicles, including retail, retail products, real estate. What do they call those? Shadow markets or money markets, shadow banks. There's lots of things that you can get invested in. You don't just have to, there's venture capitalism where the startups, right, they're starting new businesses. So you just, divide up your money into all these new startup businesses. Generally you pick out, decent ones, and then one or two of them takes off, and the rest of them probably failed. But, the one or two take care of all the costs that you put into those other ones. They had a good time, but then these one or two succeed well enough that you actually profit on them. They're kind of like long shots, but you always divide up in that kind of instance. You don't just put everything on one, right? So that's venture capitalism. You can do the same thing in penny stocks, but you can do the same thing at capital venturist websites. They'll take you to where the money is demanded. So for instance, Uber right now is in the private phase. They were just taking venture capitalists. They haven't become a stock so that they're a publicly traded company. They're just a privately, not traded, but they're privately owned by many venture capitalists. In fact, I believe that they've got something like $40 to $60 billion in their company invested right now. The same thing happened for Facebook. It always happens like this. Let's say Twitter, any of these other apps, WhatsApp, you name it, that's how it works. You can go to places like angel investor websites, crowdfund websites like Kickstarter. Just Google those things and they'll take you right to where they are. They'll also give you opportunity to open yourself up to exposure to these angel investors that are into capital venturism. A lot of times, they're not really interested in making any money. They're just looking and they see you there. They kind of like what you're doing and they like you, so they put some money on you. That's how it works. Okay. Let's see. Back to the options here. So you can get leverage here. Now the thing is, though, is you see this one right here. I can buy calls here. Now this is after the market hours. The options market is closed, so this is just an example. But let's say that, this option right here was selling for 5 cents. It says 0.05. Well, you always multiply all these asks and all these bids. Wait. Yeah, the bids and the asks. Okay? You always... Let me get this straight for you. You got a bid and an ask on each side. You got calls on the left. That's one kind of option. You've got puts on the right. That's the other kind of option. There's only two kinds of options out there. Calls and puts. Okay. All these options have 100 contracts in them. Whereas in the stock market, they've got 100 shares in them. Now you can get specialty or exotic options that do other things. They can have random numbers. You can get them custom built, so they've got a different number in them. There are many options in the stocks, the ETFs. Like I know there's many options on the Google and the Apple. And basically the many options are 10 shares rather than 100. Okay. And then you've got binary options, like you can go to Nadex, that's Nadex, and it's a different system there and different rules, but basically it's leverage and it's in an option form. Excuse me. Sorry. Different rules, different time frames, but leverage. It's the concept of leverage. And so basically what it is, how it works. I know I'm going about this in a roundabout way. I'm just trying to helicopter this and cover all this area for you. Basically, there's people out there with stacks of cash. They're bankers. They're money market makers. They're people with a lot of cash. They hire people to manage their cash. They go in there themselves and manage it. Whatever. They're borrowing credit. They're doing all this thing, and so it's not like that they don't want to work. It's not like that. They work, and their job is just plugging in money where it's needed. Okay, they can tell where it's needed based on these charts and things. And it's kind of like being an operator back in the old days where, you get a call and they say, connect me up with whatchamacallits down the street on yada yada. Yeah, I know that, and you plug it into that person, then it rings, right? So that's all it is. They're just in between, and they're just, they got a ton of stack behind them, and they're just looking for a market that needs to use their capital. It's like if you're a capital firm, right? Where you lend money out. So you got homeowners. They what they do is they buy and flip houses. So what do? They come to you. I need a cup of 6 figures here. I gotta do this. They might go out there and take a look. They might just take you at face value because they know you, and then so you borrow from them. Now you're out there with that cup of 6 figure, and you renovate the home. You buy the home, you renovate the home, and then you're holding on to that. You're paying interest on this, and then you sell the home. Then you give them back all their money. You keep your profit. They get a cut of it, and so everybody's happy. The buyer, the flipper, which is the broker in between, the capital broker at the lending capital lending institution. And yada, yada, yada. They might have borrowed money from the bank. Who knows? So, it's just get in where you can fit in. If you can't make no money, then obviously, you learn something about business, but you're going to find somewhere to do business. It's all about what you can do as well as what you want to do. Some people don't like to sit there and look at numbers. Okay? Some people want to sit there and look at cranes and, big chunks of skyscrapers and walk steel beams, talk to dudes that have been swinging around these things at hundreds of feet in the air all their lives, right? They don't want to talk to people that have only seen computer screens and little tiny digits and stuff like that. Okay, so now when it comes to these money brokers, they got capital behind them, and so what they do is they come to the options market. Now, if you want to be an options market maker, you would go to Volcube, VOLCUBE. That's a website, and their training course trains options market makers, and it'll talk about all this option stuff in so much depth it'll blow your head up. And there's a lot of things in this thing. There's the Greeks. You've got the theta, the gamma, the delta, the vega. What else? The implied volatility. I think that's all of them. And all of those things affect the price of these options. It's not just the up and down movement of the stock or the spot price on the underlying product. It's the Greeks, how they're affected. So if the price goes up and down real fast, then the implied volatility is higher, and therefore the price of the options goes higher. But if the price is moving slow again, then the IV, or implied volatility, goes down, and so the price on the options goes down. There's also the delta, which determines how much you can get. So for instance, the deeper into the money here, the higher the delta, right? So if the price moves one notch here, these are $5 notches. Each of these is a strike price, right? Each strike price on the S&P 500 E-mini options is $5. So each strike price, you might get I don't have my delta on here because I don't really use it anymore, but you would get let's say a 90% or a 90 delta, meaning that for each strike price that the price moves, you get 90% of that full strike move. So it's 90 cents on the dollar. But down here, you get less. You get maybe 15 or 25. It grows. The delta grows the deeper in the money you get. Now, these gray areas are in the money. Gray areas in the money. These black areas are out of the money. So if your options expire out here, right, then they expire worthless. If your options expire in here, then they expire worth something. The options can be for a week before they expire. They can be for a couple weeks. They can be for a month, a couple of months. Some of them can be for a couple of years. And that's basically the same way that the futures work, in that they are the same way. They are for a few months. They are for a few years. The bonds are the same way, right? So if you invest in like a 6-month treasury bond, it's going to expire in 6 months, and then that's the day of reckoning. You get paid back your money plus interest. But you don't have to hold it all the way to expiration. You've got the 2-year bond, the 5-year bond, the 10-year bond, the 20, the 30. I think that one of these countries is coming up with a 100-year bond. Yeah, because there's so much central bank money out there, right? You got to have a place to put all this stuff. I kid you not. As bad as it is out there, it's still hilarious, especially from somebody that used to work for a living. And knows that the central banks just make up phony money and then hold everybody hostage for a ransom. But that's a war, and that's a different topic. So let's get in deeper here. So the deeper that your option, let's say I buy this little sucker right here. Now that's actually $5 an option. Okay. But if I want 1,000 of those options, that's going to cost me only $50. Okay. Now let's say that price goes up. So right here, the price is at, the price is at where this line is, where in the money, which is gray, turns to out of the money, which is dark. Okay? And so the line is the same on both sides because that's where the actual price is. That's where the spot price is, which is right here. Look, you got 24, 30, 25 on the bid side out there on the S&P 500 E-mini futures. And you've got 24, 30, 50 on the offer or the ask. Okay? And that's 25 cents apart. The bid and the ask out there is a quarter difference. So the spread is a quarter out there. And so the spread in here is a quarter as well between puts and between calls. Calls over here, puts over here. Okay. But that don't mean that the spread on the options is the same, because each option at each strike has its own spread. It's almost like each option is its own stock or its own futures market. And I can get a chart on each one of these. So the call at this strike right here, 23.60, has its own bid and its own offer. And I can see just by looking at it, there's 68.75 on the bid, 69.50 on the offer. Okay, that is 75 cents difference. The spread on that is 75. Okay, so normally what I'll do is I'll offer them right in the middle, right? So basically 74, 34 and a half is right down the middle. Okay, so I'll offer them that. If I've got a small trade, if I've got a bigger trade, then basically what I'm going to do is I'm going to offer, whoever I'm taking from. So if I'm selling to the bidders over here, I'm going to offer them more, right? If I'm buying from the offerers over here, I'm going to offer them more. But if it's a small order, then I'll just offer down the middle and get it done with. I might offer less and see if I can't get it done that way. Right? It depends on how liquid the market is, what time of the day it is, what time of the year it is, which market it is. Okay. Now, right now, they're actually closed. Okay. All the options markets are closed. They get done in the CBOE in Chicago. And what else we got here? Okay, so you understand the leverage. You understand that if I buy this guy right here and then price goes up, right? So I buy the 24.35 option and price goes up to 24.75. That's 1, 2, 3, 4, 5, 6, 7, 8, 9 strikes, not ticks, strikes. Okay. So 1, 2, 3, 4, 5, 6, 7, 8, 9, right here. That's 9 strikes in the money. That means that I'm probably going to be getting something like 75 cents on the dollar for each tick higher. And then as it gets higher, I get more cents on the dollar. But remember, I got into this thing very cheaply. Okay. I used a lot of leverage on here. Okay. Now, the thing is, too, is if I purchase an option here and then price heads on down, heads on up. So, how about this? Purchase an option here, right, on the bid side, right? And then price goes down in value, which means out there on the market. Okay? So, that means that this ATM line, that means at the money, which means right in front of, in the money, at the end of, out of the money. The ATM line, at the money line. Same thing over here, at the money line, right? It's where it churns from gray to dark. Okay? Then, once price has gone down, right? This is the spot price, it's going down. Therefore, the ATM line is going on this price ladder. It goes up. It's the exact opposite. So when the market goes down, the ATM line goes up. When the market goes up, the ATM line goes down. Just remember that. It's lower at the top, higher at the bottom. It's just going to be like that. Okay? Once you get the hang of it, it's fairly simple. The basic premise here that I'm trying to show you is and prove to you is that if you buy in the money and then the ATM line moves so that your option is out of the money now, okay, then it means that you've lost a lot of value. And the more out of the money it is, the more value it loses. Right? So you can actually have an option that is basically at zero out here, or darn near, or you can't sell it. I mean, you can't get any more value out of it. But the thing is, though, is you still bought it with leverage, right? So you didn't even buy it for full price. So you're not risking as much. So sometimes that's a better deal for you. It helps you budget, and it helps you spread around money around in more markets because maybe you're just really capable of finding, good deals, right? Good prices. So instead of using cash, you use options. Now the thing is, though, is that you've got a time range, right? So before the thing expires. Whereas if you're in shares, those shares last forever, as long as the company's open or as long as there's a S&P 500 futures market. Okay, and so there's a difference. So if you just want to keep on adding up more shares or more contracts or whatever, and you don't know how long you're going to hold them, or you're going to hold them for 10 years, then you don't want options, right? It doesn't make any sense for you. But if you're just investing in like the chart says, and all the news says, and so you're just like, okay, well, it's obvious that the market's going to go up right here. But if it goes past this, then I'm not worried, But so go ahead and invest in some cheap options. If it goes there, then it's a pretty good deal. You're not going to get the options don't make as much money as the shares, but you can get control of more shares more cheaply with the options. So you more than make up for it. Okay. So if I was going to invest $100,000 in Facebook at $100 a share, okay, then I would invest, out there, and the shares would last forever, yada, yada, yada. Okay. Then I would trade accordingly. But if I was going to go into the options, right, and I was going to spend the same amount, $100,000, well, let's just say I'm going to get, I'm not going to get $5 on the thing. I'm going to get something like $25, right? Because I want these options to last for like 3 or 6 months. And so I spent $100,000 on that, and they're $50 each, right? So $100,000 divided by 50. 2,000 contracts. That's options contracts. And then 2,000 contracts is worth 100 shares each. So it's 200,000 shares for $100,000 rather than rather than 1,000 shares for $100,000. I think that's right. Hold on. Let's see here. Should be 2,000. Yeah, that'll work for this. Okay, so I haven't messed you up. So everything I said is accurate. Now remember that they can be higher. They can be $250, right? $500 for control of 100 shares. It just depends on how far out. In this case, $50 for an option that controls 100 shares of a stock that is worth $100 per share, you know, that $50 on an options contract is probably going to be a weekly. So it's going to expire in a week. Okay. Why don't we just restart this though? Let's say I'm going to spend $500 for a 6-month option. Control of 100 shares for $500 that expire in 6 months. Right? So 100 shares. It's not bad, right? What is that? Still $5 a piece, right? No. 100 shares divided by $500. Just winging this, folks. What is that? $20 a piece? $20 times 100. No, 20. Yeah, 20. 500. I know a lot of people are just thinking that they already know the answer. I gotta get this number right though. Let's see here. $500 on 100 shares. Basically, it's like five times 100. Yeah, it's $5 a share. Okay, so now, okay, so it's $5 a share, right? $500 for an option that controls 100 shares is $5 a share. Okay, and that's about right for $100 stock. Okay, now I'm spending $100,000 divided by 500. I can control 200 options, not 2,000. Let's go with 200. I want these things to last for 6 months. Okay. Now the thing is, though, is that doesn't necessarily mean that I'm going to make, $1 per dollar on each of these shares. I might make 50 cents per dollar that the stock went up per each of these shares. But let's say that is the case. Okay. So I got 200 contracts here, and 200 contracts times 100 shares each is what, 20,000? Just be sure. 20,000, and I get 50 cents on each of those shares. Okay. So now remember, I'm getting access to these options because I'm doing a contract deal. That's what the option is a contract. Doing a contract deal with the market maker out there that's managing capital. They got risk. If they blow it, they blow it. You understand? So they're in a business situation too. If they don't know what they're doing, they'll blow it. Okay. So it's not, but it's no problem to me. It's actually to my benefit if they do blow it. Okay. So there is that. And it's a complicated job. I've done some of the options market maker training on Volcube, and it gets pretty deep in there. So where was I? 20,000 shares in 200 options contracts. I get 50 cents for every dollar that it goes up. Let's say that it goes up $5. Okay. So 0.50 times 5 times 20,000. It's literally $50,000. Okay. Now, if I bought, let's save that money. I can save that money with memory save. That's what MS or memory store. Save and store are the same thing. MS. Right. Now, if I spent $100,000 on 100 shares at $100 per share, and the stock goes up $5, I get $5 per share. 5 times 100 shares. No, 5 times 1,000 shares because I spent $100,000. 5 times 1,000. Right? So, dollar per dollar on the stock. Right? Every time the dollar went up a dollar, I made $1 per share. So therefore, by the time it gets up to $5 up, right, I made $5 per share. There's 1,000 shares in my portfolio. $5,000. Memory save. Let's see here. Let's take a look at the 50,000. So here's my memory on here. This is on all of the new Windows. Okay. So basically, it's $50,000 for the options deal, right? So the market maker said, you know, you can move. Here's your ability to move. How many? 20,000 shares. All right. With the leverage. Got to remember the options maker makes money on the spread. Okay. Doesn't care if you win or lose. They're hedged. Okay. They got to hedge right, though. They got to figure out all the math. They can mess that up. They can make big losses. But they make money on the spread. So they don't really care what the market does or what you do, if you make money or not. But if the market runs out into the out of the money area here, then basically, and the thing expires, they keep all your money. If they are your seller, right? So if they sold it to you, technically though, there's other people that are selling as well, right? Because you can short the options, right? So if I buy an option here, let's say this is Facebook along with the story, then there may be somebody else that sells me the option, okay? You know, the market maker is just, basically the market maker is doing what? Is just collecting sales and collecting buyers and then matching them together, right? So they may not have a lot of sellers, they may have a lot of buyers. So what they do is they sell you the contract themselves, okay? And then later on, as people want to short sell or whatever, and they get more demand on the other side, then that gives them the opportunity to equal everything out, okay? And I know I didn't perfect the actual, iterate that perfectly, but basically they're just, they're keeping a ledger, they're putting their money out there, okay? They're looking for other markets, okay? They're managing, they're investing, right? So they help out in that way, but also there's also other people that are actually out there that aren't market makers, that are just like you and I, and we're trading with each other, okay? So it's a big market, you know, and like as much as there are computers out there trading all the futures and stocks and then the Forex and everything else, there are the same things on these options, okay? And, you know, each option is like its own market, okay? You can buy it, you can short it. And there's some other dynamics here that I would get into, but I think this video has gone on too long. And I'm not doing a daily broadcast, so I'm kind of getting burnt out here. But basically I can open this guy up. And I can make a quick chart, I think. No. Well, I don't know if it can do it anymore. I know used to, you could open this up into a chart. Um, yeah, so basically, I don't know if it does it anymore. It's kind of handy though. If you're a chart trader and you're a day trader and you're day trading options, it can be a way to go. For instance, you know, if you're out here trading oil futures or whatever, or maybe you're just trading Facebook shares or whatever shares, and you've got liquid options, make sure they're liquid. You don't want big spreads. You got to have tight little spreads. If you're going to be doing this, short-term options traders need tight little spreads. And if you're just swing trading for like maybe a few days or a few weeks or a few months with a position before you get out of it, okay, you still need kind of tight little spreads, you know, so that way you don't have to have the market move like a whole leg up before you break even, right? You're going to actually profit in just a couple of cents or just a couple of ticks or whatever, right? So that's why you got to keep your spreads down. So the more liquid they are, the more computer traded they are, and those computers trade so much, right, that the market makers are able to bring down their spreads in order to cover their own costs and back up their own risks. And so the more computers that are in there, therefore the lower they can take down their spreads. And remember, they got to compete with each other. The market makers are in competition with each other. They're their own businesses. And if their spreads are too high, then the brokers are not going to them. They're going to other market makers that got lower spreads, okay? And so then they don't make as much business. They don't make as much money, you know. And not only that, they don't get as many deals in the future, right? They go with the whoever's doing the best deals in the future. So, and so, you know, if I'm out here trading on this, I can actually get leverage on this. I don't have to actually trade the futures straight out. I can keep a watch this. Okay, so all right there. So let's say I'm trading these options on the oil. This little pin right here keeps the thing on top, so I can click this and it stays on top. Okay, so that way if I'm clicking the chart, then my options chain doesn't disappear. All right, so looks like yeah, what the heck. This particular options market for the oil is not as liquid, therefore they don't have as many contracts. For the S&P 500, their options are weekly, right? So this one is actually monthly for the oil, and so might have to put up more money. It's okay though. It may not be so though, because each contract for oil is worth a lot less than a contract on the S&P 500. So take a look at that. I'm not really thinking about it too much, and obviously I don't really trade this very much. This is something that I was getting into, then I put it off for something else, and I'm actually coming back around to it here sooner or later. And I'll tell you about it right now. And you can learn about this. There's a guy named Faustus Puglisi. That's his name. And he's a madman. He lives in New York City. He's been trading online since like almost before internet, it seems like. And he teaches something called the Cyber University, Cyber Trading University, something like that. And it's got a little bowl, looks like a calf, but it's a bowl. It's got horns on there. It's kind of like a computerized bowl. You'll know it. It's he's got blue and green colors. That's his colors, and he speaks with a New York accent. He lives in the Hamptons. He's got really, really great courses. And I've taken some of them. I've been through some of his stuff, and basically he teaches you about, basically how the dark pools are trading in the stocks. Dark pools don't trade in the futures, but they trade in the stocks. Teaches you how to day trade. Basically, he takes you to his favorites that he teaches people about is $5 or less that the stocks are valued at, so nothing over $5, so that way they don't cost so much.